Yes, good morning. Good morning and welcome to Liquidity 2025. You have arrived at the Institutional Digital Asset Summit as we mark the quarter century. My name is Andrew Work, and I am thrilled to be up here on this stage to see what we have in store for you today. Why? Because I will tell you, it has been a heck of a roller coaster ride that we have been on in the past 6 months. And some people, they are riding that roller coaster up and down. They are sweating it out every day, looking at what is happening in the world of crypto and DeFi. But the people in this room are not riding the roller coaster. The people in this room are thinking longer term. You are building a future that requires deep thinking, that requires you to do hard work to build the future. We are here today because we are the people that are engaged in moving ahead the regulatory environment. We are building the technological infrastructure that is needed for the convergence of DeFi and CeFi, bringing together the worlds of traditional finance and crypto finance and digital assets. The hard work is happening here, and when that work is successful over the long term, the liquidity flows, just like the action is going to flow up here at Liquidity 2025. And so it is appropriate that we start the day with a leader in this industry. And he is coming to us with the mind, the precision, and the passion of an honest-to-God rocket scientist. This man was a real aerospace engineer before becoming a leader in the crypto world. He founded Token Insight, went on to build Asia Pacific's biggest ever crypto quant fund database. They had over $200 million assets under management before going on to become the founder and CEO of LTP. We are kicking off big today at Liquidity 2025 with Jack Young. Jack, bring it on.
I think last night is not easy, right? Yeah. Thank you, Trump. Thank you for giving us a better chance to buy crypto with a low price. Yeah, I'm Jack, and we meet everyone area in Hong Kong. And thank you. Thank you. Let's. Can I have a controller? Yeah, let's share something about what we are thinking in digital assets and what's our foresight. Okay, it's good. First one, I need to share some milestone from our own. Yeah, in the past 1 year, we get the license in Hong Kong, in BVI, in Spain, in Australia, and thank you for the support from everyone, from our client. Our business improved a lot in the past 1 year, and also the most important is thank you for our team. Thank you for your hard working. And the best, I think the biggest joy in this startup, in my journey, is like working with you, working with a crowd of good people in this industry and build the dream from our own. And how we see the market, we phrase this industry into 3 phases from 2009 and to 2017. We think it's a start point. Yeah, we saw the innovation of Bitcoin and blockchain. We understand the concept And from 2017 to 2024, we saw a lot of innovation in crypto. We saw the tokenization, we saw stable coins. We saw the smart contract. We saw the layer 1, layer 2. We saw DeFi. And we saw a lot of use cases in crypto. We saw trading, lending, asset management, a lot of meaningful things. Nowadays, what the most important is the phase 3 that we are facing. It's the institutional level for digital asset. We saw that the different players are inside. We find more and more trusted custodians. Even the top banks, they are coming in. They will solve the security of everyone's asset. We saw the more and more regulated liquidity values, like CME, like Bitstamp, like EDX, like HNX. All these players will make the liquidity more regulated and more solid. And also we saw more and more banks that provide a better banking rails for this industry, so the funds can easily move in and move out. And we saw more and more clear regulation in different regions, so in US, Europe, UK, Hong Kong. So we also think that the most top talents, when they come to crypto, they will never leave, because it's a like blank landed with a lot of opportunities. And we saw that the believers is changed. Previously, the long holder is the miners, and nowadays the long holder is like the list company, the pension fund, maybe. And today we announced the cooperation with CME. We will support the institutional traders going to CME and do cross-margin between the crypto, the security, FX, commodity together. Also, we think in this industry, the stable triangle between the exchanges, the custodians, and the prime broker is very important. Every function needs to be separated and cannot hold in one entity. The exchange, like the price discovery, the custodian make everyone's funds safe, and the prime brokers hold everyone's position. And if the exchange and prime broker put in one entity, they will saw your position. They will trade against with you. That's the order, like the tier 3, tier 4 exchange they are doing. And if one custody do prime broker, it will risk their position. Yeah, that's the things we are doing. The things for prime service, maybe you are very familiar, for the DMA solution, for lending, cross-margin, financing, and also we provide the technical service for the low latency market data and order entry. And we also run a big asset management business to provide a stable yield for the institutions. And today, I need to emphasize is like this year, we will unveil the 500 million incubation program to back the medium and small teams in crypto world, and we give them the funds to trade. We give them the tag to do, and also we give them the risk control service for them to make them can benefit from the technologies. And also we will launch our OTC platform to give a better liquidity for OTC trades, especially for the on-off ramp, for the hedging, for the block trade. And the things we are thinking for tokenization. I think now, RWA or tokenization is a big opportunity, but it moves slow. We need to build we need to build from today, and we need to have a long-term thinking for this business. And what we will start is the cooperation with BlackRock. We will support Buildo as the collateral. We will provide liquidity for Buildo. We will provide yield for Buildo. And this is our thinking for AI and blockchain. We think, yeah, nowadays it's a popular theme for everyone, and we're trying to face the AI and blockchain future for like 5 levels. We learned it from OpenAI. The first one is that thing we get it is like we can use an AI agent to access the wallet, the on-chain smart contract. And the things we are doing is like we can analyze the data from X, from financial media, from on-chain data, and trying to give some insight or some signal to trade. And I think the next level is like if we can deploy an AI agent on chain, and they can do some action, they can trade, they can bridge, or they can deploy some function on chain. I think the level 4 is if they can have some innovation itself. They can find some function, deploy the smart contract, and also it can have some risk control on chain, and it can provide some function. I think that the final level, what we are thinking is like how we can benefit from AI and blockchain is that AI is a huge huge power for the development. It will generate a lot of revenue, GDPs, and it also can use blockchain as an incentive and can use it's like a distribute layer. Yeah, how you can distribute all the revenues, because AI cannot like it don't eat, don't drink, but it can benefit all the peoples in the world. Yeah, it can identify everyone from the user DID system to find which is the real person and which function, and like some UBIs, it maybe can come true if we can combine AI and blockchain together. Yeah, that's the thinking from our side, and thank you for coming today.
Thank you very much for kicking things off, Jack. Some big announcements there. In my opening, I said that one of the important areas that we're going to have to do a lot of work in is determining the regulatory environment. And so I'm very excited for our next speaker to come to us. She's come from a long way away, but traveling is something she does. She is constantly engaged with regulators around the world, part of that global negotiation to determine what our future is going to be, whether it's in Hong Kong, New York, or London. She is the right woman from the job with an education that ranges from Spain to Shanghai, from the United States of America to her home in the British Virgin Islands. In the British Virgin Islands, she is the Deputy Director of the Specialized Supervision Unit of the Financial Services Commission of the BVI. She heads up their FinTech working group and is really determining the way forward for virtual asset service providers. She's come a long way. We're thrilled to have her here today. Please welcome Kishelle Blaise Cameron. Thank you.
Good morning, everyone. Thank you for that amazing introduction. And let me first start by saying thank you to the LTP group for your invitation to speak here today. Having looked at your lineup of topics and speakers, I anticipate that today's discussions will be very informative and productive. I'm very encouraged to see the drive and focus on key issues like institutional, integration, and solutions. I believe getting these areas right will help to drive positive change in the vast financial services ecosystem. As introduced, my name is Kishelle Blaise Cameron. I am a part of the regulatory team responsible for the supervision of digital assets and virtual assets in the British Virgin Islands. Today, my remarks will focus on the evolution of the vast ecosystem in BVI. For many decades, the BVI has been a recognized key player in the global financial services industry. This legacy has several key players that support the position. Firstly, the BVI has long benefited from a legal framework that is both robust and comprehensive. Secondly, we have the benefit of innovative business models and structures that allow for flexibility with corporate structuring. Finally, the BVI boasts a cadre of strategic expertise in a suite of well-established financial services. These include corporate formations, trust, banking services, investment funds, and most recently, virtual assets service providers. The pragmatic report entitled "The BVI's Contribution to the Global Economy" highlights the critical role that the BVI product plays in facilitating global and international business. In the latest report, it was noted that 1.4 of global assets were being held in BVI companies. This report also conveyed that 57% of that business originated from China and the Asia-Pacific region. This report, those numbers, it underscores the symbiotic relationship that has long existed between the Asia-Pacific region and the BVI. So it is definitely my pleasure to be here today, to be in Hong Kong, to speak to you about the newest product offerings in the BVI. In 2018, the Financial Action Task Force amended recommendations 15 and 16. These recommendations crystallized a call to action by jurisdictions. We needed to respond to identified risk for financial crime, specifically financial crime emanating from virtual assets and virtual asset service providers. In an effort to understand what activity was happening in the BVI market, a survey was undertaken in BVI. The results of that survey provided to us that there was already significant virtual assets activity happening from our jurisdictions. Specifically, we noted that there was already 110 trading platforms, 41 virtual assets exchanges, 157 managers and investment advisors to VAS, 20 VAS custodians, hundreds of coin issuers, and hundreds of virtual assets funds.
How do you see the evolution of the product? How do you see its effect on the market? You know, the development of the product class. Like I said, I'm kind of interested in your view of that, given your history and you were the originators of it.
I think what's super interesting about perps is they haven't yet moved across towards traditional finance. There are traditional exchanges that have tried to list them in crypto, but they haven't evolved into equities, into FX, and so on. So it becomes it's a pure crypto product, partly because those markets are open 24/7, and the reason graduation happened from dated futures into perpetuals was that investors, traders, speculators didn't want the operational burden of having to settle and roll their futures each time. For an exchange, it was interesting because you get settlement fees each time, but from a user's perspective, it doesn't really work. So you can put on a position just with a view. There are plenty of nuances to how a perpetual works that more sophisticated traders can also access. So that's between different margin currencies, between different venues, between different underlyings. There are lots of interesting things to trade where if you have the time, the skills, and the resources, you have different areas of the market that you can access which others can't. But if I'm just an individual retail user, I can go in, I can put a leverage position on Bitcoin going up, and it's very simple. The details don't necessarily matter. So it's got lots of different levels. Even though it's a linear derivative, there's a lot more to it than some of the products in traditional finance.
And do you think there will be that transition into traditional finance, so not just for the individual digital asset class, but also for the other, equities, fixed income, lesser FX, because they're not necessarily futures based?
We haven't seen much yet. People want to do it. I think as crypto exchanges get themselves regulated in let's call them proper international jurisdictions, there's a possibility we move towards that. If we look a long time back, FTX did try doing products on equities that got shut down by regulators fairly quickly. I think it needs the trader base from crypto to use those products in the traditional finance world. There's not a need for the existing TradFi market participants to trade with perps. So it's really if the crypto participants migrate across as the crypto world and other asset classes get closer together. And we may see that. I don't think it's something we see in 2025. It's going to take a while with regulators to get comfortable. It's going to take a while for exchanges themselves to develop and say, okay, we're going to look at not just pure crypto, but we might look at probably commodities is easier to start with than equities and gradually move across. So it's a possibility, but it's something we've considered. I mean, BitMEX listed FX perpetuals 3.5 years ago. Okay. There wasn't much uptake. So we're constantly looking at it, but it's not there yet.
Right, and FX is slightly different from fixed income and equities in that it is a fully fungible, globally traded 24/7 product. And so the question of do you need futures or not, it's kind of interesting dynamic. Yeah. But if I can take a quick step back and go down another rabbit hole, which is I had understood, this is a question, not a prescription, right? I had understood that one of the reasons why perps were created was because originally they weren't classified as derivatives, and because they weren't at that point classified as derivatives, subsequently changed, that they could be listed by exchanges outside of the framework of traditional finance. But do you see them very much being classified equally as the term futures, and or how do you see development of the derivatives market, in that broader sense of more liquid and more available to institutions, particularly licensed institutions? Can you give a thoughts on that?
Yeah, I mean, I think how each regulator globally is going to look at perpetuals in their own way, and that's for them to comment on. I think from a risk management perspective, it's the most liquid instrument that we have. Dated futures have been around, particularly in Bitcoin, for a long time, but the liquidity pales in comparison to what's there in the perpetuals market, and equally, the perpetuals are more liquid in the spot market. So it's the core vanilla way to hedge risks. Regulators who want to get comfortable with crypto and are going to have crypto regulating regimes will have to find a way to accommodate them because it's the most traded instrument in the market. So it has to work. I don't yet know which regulators will get there first and how their approach will look like. One of the things we do on BitMEX is have quite a lot of leverage, obviously, where we're dealing with retail clients in certain jurisdictions. That can become slightly trickier with those regulators, so we'll need to work to limit that leverage for those users. But part of the attraction is, as a retail user, you can get rich very quick if you have the right directional view, which the perps allow, and relatively safe for other market participants because most exchanges, BitMEX being obviously one of them, have a very robust liquidation system, which means that users' profits are guaranteed in some way or another. BitMEX itself sits on 37,000 Bitcoin to guarantee users' profits, which more than covers OI 3 times at the moment. So it's a safe place to do it.
And then, if we look at the topic of fungibility, many exchanges and or other, kind of platforms, ECNs, etc., they list perps. One of the challenges with the market is fungibility between the contracts, and therefore that leads us also to liquidity. And understand there's the question of profitability, both for the investors and for the venues, versus fungibility. But then if you have more fungibility, you've got more liquidity, and then, does the pie grow bigger? Of course, you are the originator of the product, and of course, you have the interest in your individual product. But how do you see the evolution of a consistent, standardized set of products across the market? Or do you think that the market is better placed where you have this fragmentation? Because, of course, fragmentation gives you arbitrage and other kind of benefits. So what's the balance point between the two?
I think we're gradually moving towards what that balance should look like. There are hundreds of crypto derivatives exchanges, which is clearly too many. Some of them are very dangerous. They don't have any kind of robust infrastructure or margining or indices underlying what's there. So some of those we could do without for sure as an industry. The fact that they will be here one day, gone tomorrow, is not good for the image of everyone else in crypto. However, I think at least for the next 2 or 3 years, we're a long way off being fully fungible for a couple of reasons. The underlying index price of perps is something that we could potentially look to align across different venues. That in itself is doesn't make a huge difference. What spot feeds go into someone's index price for a futures contract or a perpetual contract can be standardized. There are data providers who do provide indices. Some of those indices are not yet as robust as we would like to see them. So we have our own patented index system within BitMEX, which we think is fairly robust. Some of the off-the-shelf offerings right now, even though they're mathematically clever, don't actually offer a fair representation of the market, and they can actually be arbitraged and taken advantage of on those different platforms. So we're not there yet for indices. But for the other portion of the mark price of perpetuals, it's really dependent on how a price is trading on a particular venue. And that can't really be harmonized across multiple venues because the open interest is different. The participants in the market are different, whether it's particularly regional based, whether it's a regulated exchange somewhere in Europe, for example, whether it's an offshore exchange, those participants change. And the margining currencies and also the credit risk implied and the custody risk implied on those venues is also something that's going to be different. So,
and the margin calculation, perspective on risk.
Exactly. So the fair price from exchange to exchange differs slightly. That means there's an opportunity for those that understand the different margins, and also maybe have different views. So I think there would be a lot of reluctance, even for the current, outside of exchange, the current market participants, to condense everything into one or two venues rather than, let's say, 20 or 25 because of those opportunities. Eventually, someone will be faster to those opportunities than most of the rest of the market, and that rest of the market will then try and move towards a single or small number of exchanges.
Right.
We think that some of these venues will become locally regulated and a hub, for example, eventually for the US, maybe for Europe, maybe for Asia, but offshore exchanges will facilitate the trade across. Unless order matching on exchanges, you can do that OTC. That's not overly challenging, but the margining and clearing bit is really the hard thing. Traditional finance clearers tend to look at things on an end-of-day basis with margin calls throughout the day. Crypto margin calls liquidates in real time. Until we've got a way for OTC counterparties to look at that, then exchanges will be the focus, particularly for perps trading. Spot, slightly different, slightly easier. Options as well probably needs the margining that perps enjoy to get capital efficiency. The other portion of this is middleware providers, or maybe not, like middlemen who can help optimize capital allocation across multiple venues, move things around faster. Right now, prime brokers are
right. Yeah, exactly
part of that, and move that information around as quickly as possible. And custodians that can offer that as well will be successful over the next couple of years.
Which neatly brings us to Liquidity Summit 2025. Of course, you're here. Super, happy to have you here. What do you want to achieve? The kind of people that we're having at the event. Great success last year. This year looks to be the same in terms of participation. Yeah, tell us what you want to achieve and what you're seeing here.
So we think Liquidity Summit in itself, and now in 2025, provides a reach out to customers that we don't speak to much as BitMEX. So we have historically a small number of high-frequency traders that are active on BitMEX. We want to grow that institutional piece. We've been focusing on retail, not exclusively, but mostly over the last year. We want to grow our institutional traders. We think the platform has a lot to offer in terms of simple connectivity, safety, and reliability and security of custody of funds, and then backing users' profits as well, and then the liquidity that we offer. So we're looking to meet with both family offices, quant funds, but also market makers to help provide liquidity on the platform. Our prime broker business has grown from being about 1% of our total market to being about 7% now, of which LTP forms a part. We want LTP to grow into that in the second half of this year as well. So part of today is foundation for that, making sure that LTP's customers know that BitMEX is here, that we are very much focused on institutional business as well as the retail side, that we offer differences from our product maybe 2 years ago. So we offer multi-asset margin. We'll look at third-party custody. And one of the things we're looking at doing is moving our technology stack away from Europe and into Tokyo, where a lot of the other crypto exchanges are based, which reduces some of the physical latency issues that particularly new trading firms have when setting up on BitMEX. So that's kind of what we're looking for today. It's great to see other partners around as well that will work alongside customers, alongside LTP to get people onboarded and increase what we think is quite an exciting time for crypto.
Yeah. Interesting in our industry compared to traditional finance. There's much more collegiate, collaborative, even amongst competitors, so that everyone benefits, the market grows, the product grows, all these kind of good things. So that's pretty cool. Last question, if I may. When we look at policy setting, you can compare Hong Kong to the US, to Europe, and the kind of MiCA implementation. How do you see the evolution of policy? Where do you think good policy is? Where do you think there's some improvement? Anything that you want to tell us about how you see that impact on the asset class?
So I think events in the US are going to drive what regulators look at over the next 12 to 18 months, but those events aren't clear to us yet. So from a BitMEX angle, we're mostly focused on derivatives. So regimes that we think work well for crypto derivatives right now are probably the UAE, both in Dubai and ADGM, and then probably Bahamas. And that's where we're at the moment. We are looking to Europe. So for MiCA and for people or traders looking at spot trading, MiCA is quite a robust regulation, and I think a lot of our competitors are already doing that because they have established large spot businesses. For us, spot is only a small portion of what we do. So we would look to MiFID rather than MiCA. Europe.
Out as well. Now, from the regulatory environment determines the world in which the institutions have to act, in which they can play and make things happen. In the world of traditional finance, there are two outfits that have moved decisively into the digital asset space, and we are going to hear from them now. We're going to speaking.
Hope to give our opinion on how to shape them into derivatives-friendly frameworks as well.
Right. Yeah, Hong Kong, particularly a derivatives framework would be absolutely welcome, particularly for hedging of risks that people take on in a spot, and normalization of OTC. I know there's been the paper, the consultation paper, but really to be able to kind of get clarity on that. These are the kind of foundations on top of the existing spot regulation. But all this good stuff to come, we hope. Well, Sam, BitMEX, it's absolutely great to have you here at Liquidity 2025. Thank you so much for agreeing to interview with us.
Pleasure. Thank you, Sean.
Thank you.
Cheers.
Hi. You guys take a couple of photos. Can you hear me okay?
Okay.
Sorry.
Great. Welcome to Liquidity 2025. James from Kairos, right? It's Kairos, I pronounced right?
Yes.
Yeah, that's right.
Correct.
Why don't we start? Tell us what you do at Kairos, what Kairos does. Kind of introduce to the audience.
Sure. So I'm the CIO and founder of Kairos Global Management. We are a proprietary trading business, a crypto native. We have been active in crypto for about 5 years now. We're focused on liquidity provisioning and trading inefficiencies, mostly in DeFi. And yeah, I'm a reformed TradFi with about 17 years at JP Morgan Macquarie before that.
Cool. And as I know your firm, I think your firm is relatively unique because we see a very common articulation within crypto of, I trade the basis trade long short, or I do centralized exchange arbitrage, really straightforward and standard strategies. And yet you, of course, have kind of some more diverse, kind of interesting, particularly on DeFi, which is a relatively uncommon, set of businesses. So I wonder if you could talk, of course, don't want to, give away any of your secret sauce, but talk about that dynamic of opportunities that you see between those two different worlds, which isn't very common, if I can say that.
Yes, of course. So we initially started off trading basis, but this is 5 odd years ago. But I think we soon took the view that knowing where having that experience in TradFi and seeing that basis trading on centralized exchanges is effectively a bit like the gateway drug into crypto. And you could see it by sort of assets coming in. We sort of thought that, okay, well, we don't necessarily want to be in a space where we're having to compete on infrastructure and tech, that we took a view that would happen in 12 to 24 months. Let's go more into the weeds of crypto, where we feel that there are our moat in terms of protecting our alpha and our edge will be more sustainable. And we also felt there were greater inefficiencies. Okay. So if we sort of think about centralized exchanges very quickly, there's maybe a dozen that are important, maybe 20. You move to decentralized exchanges, and suddenly you're talking about not necessarily the scale of the Binances and the Bybit, but 200 venues, 300 venues across 10 different EVMs, including L1s, L2s, some L3s, like the Solanas, the Suis, the Aptoses, and the like. And so the fragmentation is why we exist. And that's what we sort of tried to enhance and provide liquidity to make it a more fair and just market.
Okay, cool. And then when you look at the DeFi side, you have the decentralized exchanges as one class. You have DeFi, on-chain lending, on-chain kind of financial things, and then you have altcoins, ICOs, the kind of far into the weeds, new projects starting up and use cases and those kind of things. I mean, I think your activity is mostly on the decentralized exchanges, but do you touch DeFi, staking, kind of yield platforms, and/or the off in the weeds or origination, as it were?
Yeah, absolutely. We do quite a lot in staking. So what one of the things we find with DeFi is that effectively, I guess, to use parlance from TradFi, the rehypothecation value or the collateral value in DeFi will be different to CeFi. Okay. So as an example, there are it could be a staking yield that may be sort of 10 to 12%. Now, if we were in TradFi, the perpetuals or the futures should reflect that collateral value and trade relatively efficient around the risk-free rate. That's not the case. So you have a centralized exchanges where maybe you'll be getting paid for funding to be hedging that risk of the staking and getting paid the staking yield. So put those together, even including your collateral that you have to deposit on exchange, can generate a kind of the returns that we would like to see and expect within crypto, especially to compensate for the additional credit risk which you take across the ecosystem, but particularly in DeFi.
Right, and then this is an interesting point of many of the people that we speak to say they would like to do, some more of the decentralized, either the exchanges or the kind of yield stuff or the ICOs. And one of the, two of the most common reasons why they don't is still the hacking risk or the kind of IT security or the infrastructure security or network security components. I'd be interested in your view on that. And then there's the exploit. Kind of how you can how price inefficiency is less in decentralized land. So what's your views on that? How do you manage that yourself, or how do you have a risk tolerance for those kinds of things?
Yeah, I mean, this is the crux of, I think, investing in crypto, because even the centralized exchanges, I know that there's been some forms of mitigation with the off-exchange storage, the likes of some of the partners that you work with, but still that risk is there. So we have models which will bring out our EV on a trade, expected value, and then have a creditworthiness score for a platform. That's based on some of our own internal models. We actually use external parties as well that are probably more focused on the smart contract tech side to give us that insight there. Bring that all back into a model to then say, with our expected return, is this going to make sense or not, this trade? So there's no foolproof way to invest in crypto yet, but we flip it around the other way. And because of that concern by many industry participants, we feel that we can get paid well to be taking that risk on. And partly because we can be nimble, we're a proprietary trading house, so we don't necessarily have customer assets or fiduciary duties, so that allows us to handle that side of things. But it's something, I think, that you strip it all back within crypto, and why yields where they are, why we're getting paid, why in bull markets can you make a certain amount of money as you can versus TradFi, and it's strip it all down, and it is a credit risk, counterparty risk trade ultimately.
Okay. And then in terms of the relative size, we know that DEXs are about, from a volume point of view, 1/10 the size of centralized exchanges, thereabouts, we should say. And everyone was surprised post FTX how there wasn't more of a migration onto decentralized hosted, kind of wallets and those kind of things. What do you think is required in the industry to be able to see the promise of decentralization in all its articulations, be a larger part of the ecosystem?
I think centralized exchanges are always going to play a part, right? Because they provide the best user experience. And you think about the apps, the Binances, the Bybits, the OKXs, everything's in one spot. They're gamified to a certain extent. So decentralized finance does not offer that. I think that the part of the problem, for instance, is DeFi doesn't work particularly well on mobiles, for instance. Okay. So where you really have to be accessing on a PC or a Mac, you have the wallets, which can be challenging to deal with. You have the addresses and transfers to gas to think about. But I think what's going to happen is that at the moment, DeFi the investment has been very focused on infrastructure and building L1s. There's a proliferation. There's too many chains really at the moment for the amount of out of business. Where we're seeing now some of the development is actually more on the product side of things and making that user experience a lot better. An example from that was, if we think back to the Trump meme coin, and there were apps which out of the US allowed instantaneous pretty much transfers from American bank accounts onto the chain itself, not just a SEX, to be able to go by, because if you remember, Trump coin was listed 3 or 4 days before it made its way onto the centralized exchanges. So those apps are going to be the ones of the future that really lead to that growing activity base in DeFi.
Oh, super interesting. Yeah, interesting. All good stuff. You're here today, Liquidity Summit 2025. Tell us what you're expecting to achieve, anything you're interested in watching from a panel point of view.
Yeah, one of the things that I really liked about last year, we attend various conferences, but was the focus of this conference on matters that traders care about. So liquidity, technology, fragmentation, infrastructure development. So it's kind of like the language which we want to hear about the development of the ecosystem are the topics. And with that as well, that it brings a certain type of delegate to the conference that is more interesting to us. So it's like for like. So already today, I've met a family office. We're already an hour in. A fund of funds, a DEX that's launching. It's trying to sort of be a Binance on chain. So that's the kind of stuff which we want to be doing in an event. So fantastic.
Right. And indeed, that was our original purpose. And I think you can see there's lots of Web3 conferences. There's lots of crypto conferences, but there aren't that many that talk about the market. Of course, this is what we want to talk about. So, of course, this is the aim. So it's good that you're appreciating our endeavours in that respect. Moving on, another topic. When we look at policy setting at a government level, and then of course it gets reflected in regulators and articulations, regulations, and those kind of things. It's all good. But when you look at policy level, we have Hong Kong, which has in recent couple of years been very, very pro digital assets, Web3, encouraging people to come. We have MiCA, which is a European way of doing things in a European way, which is fine and has some structure to it, which has got some good and bad parts to it. And then of course in the US, a very different environment now than if you were to go back 6 months ago. So how do you see, and any one of those and anywhere else, how do you see global policy or regional policy at a government level and how it impacts our asset class and development of the product and the industry?
Yeah, look, for us, it's really about one thing, which is the US. I hate to break it to the Europeans, but US is the home of capital. That is what global markets follow. That global liquidity follows. And so I think one of the reasons that maybe people are sort of asking why the prices haven't gone up as much the last 12, 24 months, not particularly Bitcoin, but certainly altcoins. There's various reasons. You can go into questions about fundamentals or not, but part of it is there has been a lack of flow into the industry. So if we think back very briefly to 4 or 5 years ago, at bringing capital into crypto from non-crypto sources was far, far easier from a variety of sources, retail, institutional. So and so that's required for that sort of next leg up and for the market cap to continue to grow. Now, what you're going to see is over the next 12 to 24 months, despite the current macro environment, but the hopeful policy announcement and progress that we see out of the US is going to give the green light for serious money to come and invest into our ecosystem. Right. And that changes the game. So to give you one example at the moment, particularly, if we think about the microstructure of assets within crypto, you generally have market makers are a huge player, VCs are a large player. But if you look about TradFi, like the serious players are generally your Fidelities, your Wellingtons, your Capital, but secondary market liquid investors. It doesn't really exist in crypto at the moment. So I think that is a huge growth area where you will see funds that will be raising 50 to 100, 200 million, and they'll be buying secondary market tokens and on fundamental basis, on cash flow, maybe start to try and DCF type analysis. But that is required for the market to grow from its infancy and to grow in size as well.
Right, very interesting. Yeah, we kind of see the same, I think, this burgeoning money coming to the market, but not quite there yet. A few infrastructures and a few standards and a few, theses that need to be understood by a wider set of investors. But anyway, James, Kairos, it's super good to see you here at Liquidity 2025. Thank you very much.
Thank you. Appreciate it. Okay, that was fun.
Good time. Do you see me coming? Yeah, good. Good. So how will you...
Okay.
Yeah, good. Good. 你会告诉我什么时候 go live 吗？
它随机切的，
不是，就是说你什么时候开始录影？
我跟你说3页。
好，OK。Oh, hi, welcome to LTP and welcome Marcus and from ATFX, Senior Manager. Hello, Marcus.
Hi, Eric. Nice to meet you.
Thanks for coming. And please tell us who you are and what sort of company you're working in and what sort of industry you're in.
Of course. Hello, I'm Marcus Fong. I'm from the risk management team at ATFX Group. ATFX is one of the major FX and safety broker in the industry, and we focus on providing to global investors, including retail and institutional investors, the liquidity in FX symbols, forex, and CFD mainly. And due to some significant client interest in crypto, so we are also seriously exploring the opportunity in the crypto area. So, yeah.
Yeah. Oh, interesting. Because I was gonna say, because I do see a lot of people from outside interests, so to speak, from the traditional finance area coming into the crypto. So yeah, welcome to the crypto world.
Yeah. I mean, this is a very nice place. I mean, this event is so nice that we can meet a lot of vendors, different market makers, exchanges, and all the players in this crypto world. It's like, yeah, it's amazing.
Right, no problem. So how do you feel about the market at the moment?
Well,
Obviously,
the market today is a lot of volatility.
Yeah.
Thank you to to Donald Trump, right?
Yeah. All right. Yeah, we do see a lot of volatilities currently in the market.
Yeah.
Obviously, you know, the U.S. tariff and the market, or I should say the traditional markets is actually, you know.
Yeah, especially since last Friday and since last Thursday and Friday, and up to this morning. I mean, we're seeing significant volatility across all the asset class, basically. So we hope, as a broker, we do love volatility so that our clients have lots of chance to do their trading, and they can take the chance ride on the volatility and make a lot of their strategy, execute their strategy under the volatility, so that as a broker we can facilitate their trading activity. And yeah, that's the main thing we want to do.
Yeah. So so you mentioned you are working from a FX broker, so to speak, or a CFD broker, which is considering will be, you know, many years in this industry.
Yeah.
And then you also mentioned there's a serious interest from your clients. So tell us more about that. So how do you see the clients from the traditional, you know, foreign exchange, gold, for example, commodity, and then why they shift the attention to the crypto?
Well,
recently?
Yeah. So our clients are not the very early birds of the crypto markets. They are not the crypto native people. Basically, they are more like the traditional stock investors, and you know, FX and CFDs products are one of the most, or probably the most heavily traded product in the world based on the trading volume.
Yeah.
So because of the volatility, they recently very love trading gold and some of the major FX symbols. While, you know, crypto is now a household name, so everyone must have heard of Bitcoin and maybe Ethereum, maybe some of the altcoins as well. But their knowledge and their expertise or their existing trading strategies are basically built on the FX and CFD products instead of like the crypto one. So, and because of their significant trading volume, we find a little bit difficult to provide them with sufficient liquidity for them to execute their strategy, because, you know, compared to the traditional FX symbols or gold, like crypto liquidity is more thin. It's much thinner than FX liquidity. So our clients, when they start trading Bitcoin, like they trade in FX, they often experience a slippage.
Right.
So that's why we want to provide them with a better solution for their trades. So that's why we recently very seriously start looking into counterparties or partners who are able to provide us with sufficient and nice liquidity, because we are like as one of the major CFD and FX broker in the world, our trading volume is just a lot. So we would like to make sure that we have secured enough liquidity, good quality of liquidity.
Is a global industry that we're working in. What you just heard there, I'm hoping we're going to be able to get those guys in for interviews. They seem like pretty friendly guys. I'm sure they will. So once again, go to the LTP LinkedIn, the YouTube and Twitter channels to make sure that you can see the post-event interviews. So that'll be very exciting. So we are moving on to our next panel. It is going to be led by Moishe Shen, who's coming to us from Wintermute, where he is the Director of Business Development and Partnerships, and he's going to be leading a panel that is going to include Cal Chan. Cal is with EDM, also known as, EDXM, which means that he is in the global realm, running the operations there. Going to be joined also by Neil Thomas. Neil Thomas, we're excited to have him joining us today from Asia Next, where he is the Chief Commercial Officer. Also going to be welcoming Bobby Zagata. Bobby Zagata is with Bitstamp, has a dual role as the CEO of Bitstamp USA, and he is the Global Chief Commercial Officer. Kevin Saunders is coming all the way from Australia. He's with the multi-tentacled, multinational Kraken, where he is in charge of licensing operations. And then Stefan Lutz, the CEO of BitMEX, is joining us up on stage. So ladies and gentlemen, please welcome our big panel. Here they come, led by Moishe. Moishe, bring them on up. Let's go.
Good morning, everyone. Thanks for coming to our panel. I've got a very esteemed and experienced panelists with us today. My name is Moishe Shen. I'm based in Singapore, Wintermute. I've got Cal, I've got Neil, Bobby, Kevin, and Stefan. Maybe I'll quickly pass over to them for a bit of introduction of their current role, what they're doing, the exchange, but also their previous role. I think it'll be pretty relevant to what we're doing, talking about today. Cal, how about you first?
Hello. Cal Chan, EDX Markets, Head of Institutions, EDX Markets. I am responsible for global expansion and commercial efforts. Excited to be here.
Yeah, hi, Neil Thomas, Chief Commercial Officer of Asia Next, formerly with the SIX Group, Swiss Stock Exchange. I lead the business development, the products and marketing teams of Asia Next. So we operate 3 exchanges, so crypto spot, derivatives, and a securities venue. Nice to meet you. Nice to be here.
Hi, Bobby Zagata. I'm CEO for Bitstamp USA and Chief Commercial Officer. I've been with Bitstamp 3 years. Prior to this, I was Chief Commercial Officer at Kraken, and before that, I was on the leadership team of CME Group.
Hi, I'm Kevin Saunders. I'm with Kraken. I'm the Director and Head of Licensing Operations in Australia. Formerly at Non-Correlated Group, which was a asset management company that I founded. Great to be here, thanks.
And Stefan Lutz, CEO of BitMEX. BitMEX is basically the first crypto derivatives exchange out there. 10 years operating, first to have proof of reserves, proof of liabilities, never lost a coin, really neutral, institutional grade, but combining institutional business and individual traders.
Thank you. I think some of these guys are some of the most well-known exchanges around the world in crypto. A lot of experience in TradFi as well, running TradFi exchanges. My first question is, I think the most important one of the session is regulatory and market dynamics. So how do regulatory divergence across regions affect liquidity and market access? And what strategies can be deployed to improve market efficiency while ensuring compliance? Does anyone give a shot first?
Well, at EDX, we focus on building institutional-grade infrastructure for digital assets. That means navigating through regulatory fermentation is really part of what we do. Meanwhile, providing a safe and a robust platform. For context, EDX was incubated by Citadel Securities about 2.5 years ago. Since then, we expanded globally we're now headquartered based in Singapore.
So yeah, I think when we look at regulatory and how these things move forward, I think there's fundamental principles that what regulation brings to global exchanges and how the landscape looks for that regulation. I mean, my experience, we've been building AsianX for 3 years, and we've looked at the global landscape. We're based in Singapore, and why did we choose Singapore? I think we looked at it because regulatory clarity, which was a real critical piece for us. Like, how do we know that what we build is going to be suitable for that market? And we look at it purely from an institutional perspective. And as probably a lot of people know, Singapore don't focus on the retail side of it. But from an institutional perspective, we looked at that. Now, when we look as a global participant in this market, you see different regulators offering different types of regulation to that market. So how do you find the right fit for your offering? And I think you have to build around, if you want to really attract institutional liquidity going forward, you have to build in that market if you wish to be regulated to that scheme. So we started in Singapore because they looked at it, basically they say, okay, we have a clear guidance on the spot side. They also allow digital securities in the same format as securities, which gives you a lot of clarity. But they interestingly don't license derivatives. They permit derivatives. But being a regulated venue, then you have to look around the world and say, where can I go and regulate derivatives? What can I do to make sure this is... And we actually speak with the likes of MAS to see, how can we bring that into the purview of you? And had this consultation. But then obviously you have to look internationally. So how do you then get... One of the things I'd love to see more is standards around regulation, because people want the clarity, investors want the security. So we're very keen to sort of to have dialogue and communicate with various regulators around the world to see what we can do to harmonize the offering, that where people trade irrespective globally, that there is some uniformity. And that's one of the things we've been really focused on over the last 2-3 years.
Yeah, thanks. Couldn't agree more. A couple of things you should know about Bitstamp is we're the longest running exchange. We were founded in 2011, so we've been at this a while. And going back to our founders, we leaned into the regulatory compliance side of the marketplace. So today we have over 60 regulatory licenses around the world. And my answer to the question is it requires investment. It adds cost that there are so many different regulated jurisdictions out there. But our aim is to serve customers who want to work with a trusted partner. So we make that investment in order to create access. But we are able to provide a common liquidity pool on the back end. So we get a lot of benefit, and our institutional clients in particular get a lot of benefit from our diverse types of flow and market participation.
Yeah, great. I know that Kraken is a firm that has a commitment to regulation. We've certainly have many licenses around the world now, and we've got a commitment to expand that. I think one of the things that exchanges generally need to start to contemplate is that you can't really run a global financial services company. You need to localize as much as possible. You need licenses for that location and people with that skill set in that location in order to meet that market's specific requirements. We're starting to develop and evolve to that understanding at Kraken. We're also expanding our interest to traditional markets as well, so that we can create a bridge between the conventional markets or the TradFi markets and crypto in a more unified way. You may have seen in the news that Kraken recently acquired NinjaTrader for $1.5 billion. It's a major deal in the crypto industry. It's a way in which we can bridge between the traditional markets and the crypto markets as something that is a bi-directional flow of liquidity, and I think institutions will see what we're doing and say, well, they obviously understand how to do it we understand how to do it in the traditional markets now as well as in the crypto markets, so maybe that helps improve trust and helps improve people's willingness to do the due diligence required to cross over into the realm of crypto.
So first of all, let me start with not asking the question, but answering the question what regulation is good for. Actually, regulation, you want to have regulation to trust the integrity of any platform you use, which is something that BitMEX has been true to since its foundings. We are neutral. We have been the first to be fully KYC'd, run full AML programs. We finished that basically the implementation in 2020, way earlier than basically many of the other platforms in the space. We run trading supervision. We don't make markets on our own platform. So we provide undisturbed price discovery, which not all people like, because undisturbed price discovery means you see how shorts and longs in the derivative space, so we're not a spot exchange, but how longs and shorts work together, which you see in the funding rate. So if the funding rate is particularly high, we believe on our platform it's the real funding rate, right? Second one is, it depends on what asset you look for. If you look at the main crypto coins, I mean, we frame them these days in a different way, but if you look at the big level ones, L1s, and Bitcoin, for example, those are global markets. Those are not localized. I agree with my fellow panelists that we will see jurisdictional liquidity aggregation. Liquidity aggregation means, from my point of view, what you in the traditional finance world call buy-side. Asset managers, etc. They will rely heavily on localized exchanges to tap into the markets. But still, you need a global market because this market is 24/7, 7 days a week. And if you're not there as a sell side, I mean, in traditional finance, I come from Deutsche Börse, I've been with PwC for long, so I know both sides. And there, the sell side is basically 24/7 too, but OTC. So if you want to tap into this, crypto exchanges on the derivative side actually provide something there because it's more than just a localized aggregation. I believe we will have a tiered approach where we will see localized liquidity aggregation, especially from the buy side, because buy side needs this trust and rubber stamping from regulators that basically enforce kind of the trust there. Whereas on the sell side, it's way more a closer, versed community, applying the same principles, but it's slightly different.
Super helpful. I think the next question is, we all hear institutions coming. Are they here yet? So, I mean, all the back in 20, 21, 22 institutions coming. I think there's different form institutions. So my question is directed at Kevin and Bobby and others, feel free to chime in as well. Is the current level of liquidity sufficient to support institutional demand? And if not, what are steps required to address this gap?
Yeah, this is a good question. Are the institutions already here? Well, I think the first thing we've got to ask is, what is this term institution that gets bandied about? I mean, different definitions for different groups of people. We're talking about primarily the difference between buy side and sell side to begin with, and they have different needs. If you talk to many conventional sell side brokers, they're not looking at perhaps the spot exchange side of things. Maybe they're thinking more along tokenization lines. How can we use the new technology to sell structured products? How can we use these new technologies to sell bonds, to sell short-term interest rate products, things that we already have on our books with skill sets that we already have in-house? How can these new technologies help us do that more efficiently? And a lot of ways they are still asking the question why. Why are we doing tokenization for a money market fund? Why are we doing tokenization for a bond? The bond markets are very liquid. They're very easy to work with. What future do we see with tokenization and what problem is it solving? So on the sell side, there are some significant challenges to bringing that kind of institution to the table. On the buy side, I think you have a very strong argument right now for 1 to 3% portfolio Bitcoin in a 60-40 portfolio. There's plenty of evidence out there now to say that we can get a better return with minimal impact to Sharpe ratio. So that's a strong reason for institutions to come. The problem, though, still remains that is there truly enough liquidity? And on top of that, is there evidence that best execution is taking place? A lot of these larger institutions do their execution analysis and they say to themselves, are we truly getting the best price? Is there any front running going on with our orders? Is there transparency on how these orders are being filled? These questions are really important to be solved, and anything that involves greater transparency on the execution side will help the institutional case. Clearly, we need to look at the custody component as well, and we need to look at ways in which we can greatly improve the pooling of liquidity in geographic areas. And I think that's largely due to regulation. So in areas where there's more permissive regulation, you get concentration of liquidity. In areas where there's tougher regulation, it's harder to get a broader range of liquidity. So there needs to be new ways in which we can bridge these different concentrations of liquidity for institutions to start coming into the mix.
Charlie? Yeah, I think our institutions here, look around, yes, but then again, no, right? So there's still, I think of it in terms of waves of adoption, and I think we're at a really interesting inflection point because, you know, the pioneers are in, you know, the risk takers are in, the sophisticated traders are in largely, but now we're dealing with a different set of institutions, buy side largely, and others who have a different set of needs. And at Bitstamp, we're trying to anticipate and work towards this kind of newer set of needs, right? They're more conservative, they're more regulatory sensitive, they're more product centered, as Kevin mentioned. So we have to work as an industry and then as venues to make a way for them to come. Now, my editorial on this is, I also don't want to rush to the traditional financial services workflows in all cases. Like I think there's been a tremendous amount of innovation in crypto, and we're in danger a little bit. Many of those more traditional players just want us to adopt all of their workflows, and I don't. That could be a good answer in certain instances, but clearly not in all instances.
I'd like to just quickly add to that. I love this viewpoint, and the interesting thing about, I mean, it didn't bring me to the crypto world, but it was an aspect of it, and how easy it is to combine. For example, if you're TradFi, you have trading desks, or even if you're an asset manager, it's the same. They look at spot, they look at derivatives, right? Then they look at asset class. So it's highly fragmented because it makes sense. Because in the back-end structure, you have everything. In crypto, you basically need to look at both at the same time. I mean, you have spot, and I think their liquidity somewhat is still an issue, especially in the regulated exchange space. Derivatives is not so much an issue. There is way more liquidity, but you need to understand what you do. So, for example, if you go long Bitcoin and you allocate some of your portfolio, use this Bitcoin to have a derivatives overlay, but it basically needs to be done by one trading desk. If it's split across how it's done in TradFi, it will provide you or whoever does that with a lot of pain. Not unnecessarily, and you can get around this, but you get the full benefit only if you do it. So I think it's a two-way educational process. So the original crypto guys, in a way, like us, or Bitstamp is a spot exchange forever, basically. So you know your game quite well. but how do we combine that for you to make it easier? But at the same time, from the especially asset managers as well, as you said, the complex guys, the known guys, they're all in already. They have built that. That's fine. But that's the next step. I think it's a two-way educational process to get into it, to really understand what's going on there. Because many questions we get is, what do you actually do and how you do it? How can you run a derivatives exchange without a CCP? And we tap into the likes of the clearing fund or the insurance fund, how we call it, and the mechanics behind that. What's the funding rate? We never heard of a funding rate, right? And why is it fluctuating so heavily, et cetera, et cetera? So two-way educational process. Other than that, I would say there is liquidity. There is even, I would say, sufficient liquidity, maybe not for the adoption that's to come, but it will come automatically, I believe.
I mean, just to add to that, I mean, so we look at this purely from an institutional basis, and we look at across the broad market with the securities as well as crypto trading. I think what's to drive liquidity, I think there's I think clearly someone mentioned regulation is critical to bring in tier one style operators. The use cases that you're seeing now are really about tokenized money market funds. You're seeing a lot of big US buy side coming into this space in the last 18 months. Under that, and we talk about issuance of some of these products, and we list some of them now. That's bringing it, but also more capital needs to come into this space. The amount of capital being deployed, I mean, I hear time and time again, we need more capital to invest. I think if you want to bring the full force of institutional capital into the crypto space, it's got to be on the basis of good, sound governance, good regulation, because that provides confidence. And when I speak to institutions, it's not just the sales guys or the business leaders, it's the compliance desk, it's the risk teams as well. So they need to understand the fundamentals of what these platforms or the industry is doing, and that builds confidence. And I think that's really the critical function, is just to tie it back to regulation a bit. We want the capital in, but we've got to, we want the innovation, but we've also got to have the foundation of the rules, right? So that people know that my money is safe. And this is really assures the long-term growth of the crypto industry.
Well, I do agree with the rest of the panelists that we have the reflection point. I've been in this industry since 2019. Ever since I started it, there's always a saying that institutions are coming. But I think this cycle is quite different than the previous one. So I think for a couple of things. One, the governments around the world started warming up to this asset class, so it's not going away for sure. That's number one. And number two, I think this cycle also has all the other, I would say, rails and tools that would actually suck in more institutional money, such as tokenization assets and stablecoins. And as EDX expanding into other jurisdictions, we do see increased interest and demand from our institutional clients, but not just about trading more pairs, but it's about asking for more stablecoin settlement and also yield-bearing tokenized assets. And I think that's a new change from previous cycles that I work in.
I'll probably also add our 2 cents that we see Wintermute. In a way, on top of being one of the largest prop shop HFT traders on a lot of the exchanges, both regulated as well as unregulated exchanges, we also operate one of the larger OTC desks around the world. Back at TradFi, if you're a hedge fund, you want to buy a big block of something, typically they go to bank and they will try to broker it or try to warehouse it. That's essentially what we do. So are the institutions coming? Yes, they are coming. Not all at once, but over the last couple of years, we've onboarded some of the large institutions around the world asking us for block pricing, either via chat or via API, so fixed API. The language that a lot of the banks speak, we are streaming that to some of the largest institutions around the world. So just trading every day. So that's been going pretty well. Next question is on liquidity fragmentation. One of the things that we don't really have issue with in TradFi, everything traded on one venue, pretty much, non-fungible futures, etc. In crypto, we do have that issue because there's so many central exchange out there listing fungible products. So my next question, maybe we start with Stefan first, and then others can chime in. How can the industry address liquid fragmentation across central exchanges, but also decentralized trading venues? What tools and innovations can bridge this gap for institutional participants?
Yes, maybe just 1 or 2 sentences upfront to explain. Why don't we, or why don't you, or whoever trades, why don't you have an issue with liquidity fragmentation in TradFi assets? Because every TradFi asset has a home market, full stop. Because it is the market where either the underlying asset is incorporated. So for example, if you have a US stock from a US company, one of the US markets, NASDAQ, NYSE, whatever, will be the home market. You have secondary listings, but they don't play a role, basically. In derivatives, it's the same. Basically, every derivative has a home market. You have secondary markets, but they don't play a role. Because many of the digital assets don't have a home market. They might be registered somewhere. But for example, Bitcoin has no home market. There is no home market regulator. So you can't, regulatory-wise, enforce one jurisdiction to become the home market. That's why we have that fragmentation. And I believe, as we spoke earlier, we will see local regulated liquidity pools where the asset managers, so the buy side, will aggregate liquidity. But we will have a couple of exchanges in spot and in derivatives who will play that pseudo home market role. Not 100, that's too many, but we will see local exchanges managing the local pool, and then you have sell side players, let's call it players, I don't think it will be the banks, but people like you, for example, or other traders, market makers, etc., who will make global markets on those global platforms to then have the actual price discovery mechanism on a global level. That's my assumption. I can't look into the future, but that's my assumption, because we won't see those home markets from a regulatory point of view.
And maybe I could chime in as well. I agree. It's quite interesting. On the traditional side, it became regional at some point, these home markets, right? But the very nature of our marketplace is quite global and quite boundaryless. So it's going to be interesting to see how it plays out. There's a couple of things that I think are important. Firstly, you know, in the crypto world, venues can serve retail customers and institutions, which I think is a great strength. That diversity of flow creates opportunities. As some of you may know, Bitstamp is currently in a transaction with Robinhood, and we expect to close that this quarter. That's going to be quite transformative for our markets because it will create opportunities. So I think that's important not to get lost in the equation. And then the second thing I would highlight is, from an institutional perspective, there are companies like LTP out here, and thank you again, Jack and the team, for hosting us. You know, that bring together a value proposition for institutions that's hard to beat and is quite collaborative with the venues.
I might add that if we could be a little bit idealistic for a moment and talk about derivatives in particular. In the States, CME's got about 55% or so of the crypto derivatives market, which is par for the course for such a dominant exchange globally. But just think for a minute what the total liquidity picture is like if you combined all of the offshore exchanges' liquidity books into a more unified solution. And it may be somewhat idealistic to speak in this way, but if there was a way to incentivize all the exchanges to combine their liquidity, we would be vastly more liquid than the CME, vastly more. So it seems inherent in the system, there is a pathway for us to, as a collective of exchanges, to dominate and become a world market, so that our home market becomes the world. Now, what is the way that we can join forces in a way that makes economic sense? It may have to be something in the form of centralised clearing, but not in the traditional way that centralised clearing works. In the old model, you have FCMs, or brokers, aggregating all the customers, and then that as a collective becomes a clearing member to the clearing house. We might be able to do something different. We might be able to have a truly decentralised clearing model where every individual becomes a clearing member in a small way. And then if there's a unifying clearinghouse system that allows all the exchanges to offset their counterparty risk into a centralised pool, then we could theoretically make all of these exchanges now combine into a singular venue and really revolutionise what we're doing globally. So I'd just like to sort of echo what I've heard previously from my colleagues here, in that we don't have to revert to the way it's always been done in TradFi, but we can learn from what has happened in the TradFi space, especially when it comes to centralised clearing, and create a new innovation in that space which brings together all of our liquidity into a central global venue for these products, but also at the same time addressing things like best execution, which is going to be a repeating theme across all these regulated localities, and counterparty and credit risk for all of the institutions, which is a major factor in their decisions to play in the first place. So I'd like to just sort of say that perhaps there is a way that the new world can learn from the old world and create something that's actually innovative to solve these liquidity problems.
Perfect. I know we're running towards the end of the panel. It's been super helpful and experience from panelists. I've got one fun thing that, if we keep to maybe 20, 30 seconds each, what's some upcoming at your exchange that you're most excited about that everyone in the audience should know about? Maybe we start with Neil.
Yeah, thanks, Moshi. So AsiaNext, we went live last year with our derivatives products, and we've been building heavily. We've all got a bit battle weary from building, but we've finally got the last piece of that jigsaw over the line. So we'll bring our spot venue live, which means that we'll be able to offer a basis trade on venue, and then combine that with money market funds. So we'll look to really drive the capital efficiency play in the market. So making sure that there is no capital at rest, and that all of your assets can sweat. So we're really excited about that. We've gone for the MAS licensing, which is a high bar to clear. And you have to have patience to do that, but we finally over the line there, so we're really excited to have that coming live soon.
Cal?
Well, just to add to what Kevin was selling, right? So DDX does have a centralized clearing model, right? So it's live. So you please come talk to me, and we can learn more, talk more about that.
Bobby?
Yeah, just 30 seconds. Two things. On the derivative side of the crypto marketplace, first of all, I think perpetual swaps is a great innovation, I think coming from BitMEX. And secondly, I think 95% or some of that flow is offshore and lightly regulated jurisdictions. And so I think we need some regulated alternatives. And I'm not able to make a product announcement right now, but let's just say Bitstamp is very interested in delivering a fully regulated perpetual swap offering in the near future.
Exciting.
Kevin?
So Kraken's going to continue with its mission. We want to make a truly unified experience across multiple markets, including crypto and traditional markets. We've acquired a broker-dealer in the US, and it's already live with over 11,000 US equities available to a select few in the US at the moment, but it's rolling out globally. We've acquired NinjaTrader so that we can access the CME products and other products on other regulated futures exchanges. We're looking at doing unified balances. We're looking at doing things like span margining and portfolio margining for greater capital efficiency. And we hope to sort of be instrumental or pioneering in the drawing together of all different sorts of markets and all different ways in which people can speculate and hedge in one location.
I'll try to be short. Just two things. One is bringing more traders, and especially informed traders, onto the platform, which will spur liquidity. And number two, it's not quite a uniform or unified order book, but moving our data centers into the locations where most of the other exchanges are too, so that actually institutional players can synthetically create their own unified order book in a better way and sub-millisecond abilities.
Amazing. Thank you so much, everyone. If you have any questions about any of us, just feel free to come and find us outside.
Thank you. Thank you.
I'll take any microphone I can get. Great. Thank you very much. Great job, Maisha. Well done. Thank you so much for leading our panel today. Great job these guys are doing. And once again, we are going to have them on the floor. They're going to be doing interviews. We are not taking a break, so don't leave your seats. If you are in the back, we have seats over here towards the front, and you are definitely going to want to take up some of those seats, so we'll encourage you to do so. We have a moment for you to make a move on the front row while we transform the stage. Your hashtag for this event, if you're taking pictures and posting to social media, whether in here or out there, is hashtag Liquidity 2025. It's obvious, really. And as I said earlier, you will be able to get interviews with some of our speakers later on the LTP platform. Start with LinkedIn, but if you also need to check with their Twitter, with their YouTube, it is at LTP_Prime Broker. So around the world, institutions are taking up digital assets, and different jurisdictions have decided they would like to be a leader in this sector. And one of the places that is moving ahead with establishing a clear regulatory framework so that digital assets can thrive is Hong Kong. And so now we are very excited to bring you one of the key players in shaping that regulatory environment. He is the Undersecretary for Financial Services and the Treasury of the Hong Kong Special Administrative Region of the People's Republic of China. We would now like to welcome to the stage Mr. Joseph H.L. Chan. Joseph, please come and join us.
Jack, Evan, distinguished guests, ladies and gentlemen, good morning. It is my pleasure to join you at the Institutional Digital Asset Summit. My sincere gratitude to LTP for organizing this summit, bringing together global financial institutions, regulators, and innovators to shape the future of digital assets and fintech. Hong Kong has always been a bridge between traditional finance and technological innovation. As an international financial hub, we are committed to fostering a vibrant, secure, and forward-looking ecosystem for digital assets. As a leading international financial center, Hong Kong enjoys a distinctive blend of advantages under the one country, two systems. On one hand, our core strengths include free flow of capital, free convertibility of the local currency, a robust common law system, and simple and low tax regime. On the other hand, Hong Kong enjoys preferential access to mainland China market, the world's second largest economy, growing at about 5% per annum. These dual advantages position Hong Kong as a superconnector between China and international markets, between the East and the West. Indeed, Hong Kong ranked third in the world and first in Asia under the Global Financial Centers Index. We are determined and committed to financial innovation, and we are actively advancing our regulatory regimes to embrace the unique opportunities of virtual assets. The Hong Kong SR government issued the policy statement on the development of virtual assets in October 2022, reaffirming our commitment to same activity, same risk, same regulation principle. This laid the foundation for a licensing regime for virtual asset service providers, ensuring compliance with international anti-money laundering and counter-terrorist financing standards while safeguarding investors. Since its implementation in June 2023, 10 trading platforms have already been granted licenses. We have seen increasing integration between traditional finance and virtual assets. Among these, stablecoins, particularly fiat-referenced stablecoins, are playing an increasingly prominent role in the Web3 and virtual asset ecosystem. To address the potential risk to monetary and financial stability while fostering innovation, the government is committed to establishing a robust and appropriate regulatory framework for stablecoin issuers. To advance this initiative, we have been working closely with industry stakeholders through public consultation and the launch of a stablecoin sandbox. In December last year, the government submitted the draft legislation to the Legislative Council. Our approach aligns with international standards, incorporating the Financial Stability Board recommendations to ensure that Hong Kong's regulatory framework remains globally competitive while tailored to our local conditions. Under the proposed licensing regime, any entity engaged in issuing fiat reference stablecoins in Hong Kong, issuing Hong Kong dollar denominated stablecoins, or actively promoting the issuance of fiat reference stablecoins to the Hong Kong public must obtain a license. Subject to the passage of the bill, we aim to launch operation of the regime within this year with a view to expediting license approval. The government is also expanding our regulatory oversight on over-the-counter trading of virtual assets. A 2-month public consultation on the proposed OTC virtual asset licensing regime was conducted in February last year, with a second round of consultation to be conducted later this year as well. In addition, in order to ensure the secure safekeeping of digital assets in line with international standards, we will propose a licensing regime for virtual asset custodian service providers and will conduct the consultation this year as well. Hong Kong's unique role as a bridge between virtual assets and traditional financial markets has also been demonstrated throughout the years. In 2022, the first virtual asset futures ETFs were listed on the Hong Kong Stock Exchange here. In 2023, the Hong Kong SR government became the first government in the world to issue tokenized green bonds, setting a global precedent. Then, last year, 2024, we welcomed the listing of Asia's first virtual asset spot ETF here in Hong Kong, reaffirming our leadership in the development of virtual assets across this region. Ladies and gentlemen, our city's dynamism extends beyond policy and regulation. Hong Kong proudly hosts world-class international Web3 events such as SmartCon in October last year, Consensus in February this year, as well as the Web3 Festival this week as well, each of them bringing thousands of industry leaders and innovators from around the world together to explore future opportunities in Web3 and virtual assets. So on this note, I would like to thank LTP once again for organizing today's summit, bringing all of you together for the development of virtual assets in the future. The government and our regulators will continue to work closely with all of you to develop a sustainable digital asset ecosystem. Thank you very much, and I wish you all a productive and inspiring summit.
Mic 5. All right, gentlemen. Thank you very much, Joseph. I've known Joseph for many years. He's an absolute asset to the Hong Kong government here in the SAR, and so I've been very excited.
There maintains a. I think across these jurisdictions, we want to see that the principle of the exchanges wanting clients to succeed as being the driving force behind what they're doing, as opposed to what you see in certain types of brokerage where they want their clients to fail. If you look at synthetic markets, CFD markets, Forex markets in the retail space, a lot of those brokers are internalizing a lot of the flow, right. And their playbook is to B-book everybody, hold that flow internally, and wait for people to essentially blow up. Right. And that's their revenue model, right? So the revenue model is go out, market, get lots of people to come in, put $500 accounts down, and maybe hope to extract $400 out of them before they give up and take their money away.
Which is not sustainable.
Well,
in terms of encouraging people to grow and diversify.
Well, I mean, this is a market that's still very mature across the world. Forex brokers, CFD brokers, a lot of them operate in this way. Whereas at least the crypto exchanges, from my experience, are open order books. You can place orders in the book and you can match with other third parties, and most crypto exchanges aren't actually actively trading with their customers. So that business model is much more hoping that people are successful, and so that they stay trading and have a long-term relationship with the exchange service provider. So I'm hoping that's the way it continues. There's certainly elements now with the coming regulation where the other types of brokerage organisations are coming in and trying to entice crypto exchanges to come with them and let them handle all of the middle and back office challenges and the compliance challenges. But I think you lose something when you sign up with that kind of a business model.
Okay. And thank you for that. It's kind of super interesting stuff. In terms of product development or market product development, anything interesting coming along? So, for example, talking about FX, where you might see a synthetic FX being the dollar-denominated circle coin versus the euro-denominated circle coin as a kind of synthetic FX. But like I said, I'm just...
Yes, of course.
Anything interesting product-wise, either Kraken's developing?
Well, Kraken, of course, is having quite a maturation cycle at the moment. I think Kraken has 3 core business units, you might say. We have a very consumer-orientated instant buy style product, which has a very simple interface for people who don't want to be faced with too much technology and have a very simple, I want to buy and hold Bitcoin in my own wallet, I want to DCA Bitcoin and have those sorts of features without too many bells and whistles and keep things simple. That's a big portion of our business. The prosumer or the professional, which wants all of the charting, wants to be actively involved in trading and so forth. And then the institutional business, where they want large size execution, they want all-in pricing from the OTC desk, they want to be able to have a one-stop solution for best execution and items like this. Now, Kraken has had that structure for quite some time, and we're expanding beyond just crypto now to include traditional finance markets, including going live with our broker-dealer in the US, offering 11,000 American securities. We also just recently purchased NinjaTrader, which was a bit of a global news event. So there'll be access to traditional futures markets, and we can see in the future a unified prosumer experience where you can seamlessly travel from crypto markets to traditional finance markets, all from one account.
Just wild question.
Yes.
You ever see Kraken buying out CBOE or CME?
That is a wild question.
Yeah.
I would think that our primary focus right now is towards our IPO, and that's something that's exciting everybody internally, and I think we're building a bit of a vibe on the street about that one. Once we become a listed entity, then of course we will look to further acquisition and grow in time. I think CME is a very large organisation and it has a lot of external competencies that we would have to think seriously about before we contemplate something like this. But it is a wild question. It's something that would be a fantastic result. We'll have to wait and see.
And it was just for the sake of discussion.
Yeah, no, of course.
You know, as we see traditional finance, not just exchanges, but brokers and asset managers will become more digital-like or more moving to that asset class in the same way that we see exchanges, brokers and asset managers in crypto becoming more TradFi-like.
Indeed.
Yeah, as much as DGens would not want it.
Yes.
So there's a middle ground where we meet where, for example, a large traditional financial exchange might become a equity investor in someone like Kraken, in the same way that someone like us might purchase, traditional finance broker. These things, I think, are in the future somewhere.
Absolutely, and I think it all boils down to the fact that people love to trade with each other. They love to speculate. They need to hedge risks, and they can do that in many different ways and many different venues for many different asset classes. So that's a human condition, and we want to be able to offer as many different possibilities for that activity as possible, and as I think at the end of the day, the time where crypto sits over here in its own universe and traditional finance sits over here in its own universe. I think we're going to see a gradual merging of everything, and some of the best parts of TradFi and some of the best parts of crypto will hopefully come to the fore in the final merging and altogether oneness of the experience.
Absolutely.
Yeah.
Thank you for that. Of course, you are very kindly panelist on one of our panels in the main hall, so that's super cool.
Yeah.
Reflections on the summit, anything else that you want to achieve today, people you might want to meet?
Well, I've got a lot of meetings lined up and lots of interesting and diverse conversations, so I'm looking forward to anything that's presented, and hopefully we can form some interesting partnerships while I'm here in Hong Kong.
Great. Okay. Kevin from Kraken, thank you so much for your
Thank you
time
very
today.
much. Thank you. Thank you. Thank you. I hope that was helpful.
Yep. Absolutely. Thank you so much. It's super cool.
I think I lost the...
Is that on the back of it? Did you get it okay?
Yeah. Yeah, it's all good. Okay.
Yeah, thanks, man.
Yeah, no worries.
Very useful. We'll
Thank you.
We'll
Thank you.
wrap together with these presentations on the liquidity and everything we worked on.
Here we go. Yeah, actually, if you...
是吧？啊？
水皮，不是，是他这个画面。
没有，真的。
那他为什么是
Yeah. So that's nice and funky. So there's a micro.
Okay.
I think I explained the questions to you today. Or not?
I don't think so.
So totally open-ended.
Yep.
Go wherever you like. I'll follow you. Kind of dig into stuff if need be. If you're short for time, we can do it shorter. Or if you're okay, we can take more leisurely, kind of scroll through it. I'll ask you to introduce your role and what you do. Then we'll talk about markets or generally how we see the state of the world and the asset class, whatever.
Okay.
I'll ask you about the summit and your reflections, and then lastly, policy changes, maybe in the US. If you don't talk about US, we'll talk about Hong Kong and those kinds of things, right?
Sure. Sounds good. So how long do you want to go? Or
well, it's just
10
10 minutes, something like that.
Perfect. Yeah. Perfect.
Okay. Welcome, Bobby from Bitstamp. Thank you very much for joining us today at Liquidity Summit. If we could start by you introducing your role at Bitstamp, and of course, probably need not much introduction, but what Bitstamp does. Yeah, please go ahead.
Sure. Thank you. I wear two hats at Bitstamp. So I'm CEO for Bitstamp USA, and I'm also Chief Commercial Officer for the company globally. Been with the company 3 years, going on 3.5 years. I was at Kraken prior. I was Chief Commercial Officer there for 3 years, and prior to that, I was at CME Group on the traditional side, and I was a member of the leadership team there and ran a couple of different divisions. But one of my claims to fame was I had a hand in sponsoring and launching the Bitcoin futures product at CME.
All right, cool. And then, so tell me, I mean, it's a super interesting trajectory of your career, and so. Traditional finance, of course, CME does the listed futures in crypto, but still very much traditional listed securities and fixed income products. And of course, you have this trajectory and experience through crypto. So describe for me, if you can, how you have experienced that and then what you think the future holds for Bitstamp and or crypto exchanges kind of broadly, your reflections on that.
Yeah, well, again, I can't explain my career because I don't understand it, but I've been very fortunate and gotten to do some cool things. At CME, and I commend that institution. It's a 160-year-old institution. It's been around forever, very traditional, and a market leader in derivatives, obviously. But one of my responsibilities when I was there was the venture capital arm, CME Ventures, and they started pitching me on crypto and blockchain investments as far back as 2013, end of 2013. So I got educated on it. We made some investments in 2014.
basically it captured my imagination and some of my CME Venture colleagues, and we were able to get into a conversation with the rest of the leadership team at CME Group about the future and what this technology can represent, both in terms of opportunity and also risk to some of the traditional business models, if you will. Blockchain technology can do a lot of things that in the traditional side are done with institutions. So as I mentioned, we were able to launch the Bitcoin futures product, but back then, so when I had to get approval for this, it was 2016. And Bitcoin back then was not understood like it is today. So it was a very interesting series of conversations, but ultimately we got there.
Right. And then, when you look at not just crypto itself, but also tokenization and the idea that at some point there won't be tokenized securities, there'll be securities issued as tokens, and how that evolution goes. Any insight into what Bitstamp looks at the future and that kind of evolution? Or
yeah, absolutely. So a couple of things about Bitstamp just to set the foundation. We're the longest running exchange, founded in 2011. Right. So the track record is meaningful. Secondly, going back to our founders, we leaned in heavily on the regulated side of the marketplace. So we were the first to ever get a license in 2016. And we have what I believe to be the most extensive licensing footprint today. We have over 60 licenses globally. And our founders made some decisions early on anticipating this moment, I think, which is traditional institutions getting involved. So as far back as 2016, they made the decision to separate custody from the exchange to reduce counterparty risk for institutions. And they also made the decision, which I think must have been quite radical at the time, in 2016 to start getting global financial audits, because they viewed that as the gold standard for trust. So I'm quite confident that we're the only crypto company on the planet that can say we have 8 years, almost 9, of clean audit opinions from a Big Four accounting firm, no less.
Cool. Yeah. And so then, when we look at my perception of the post-Trump, kind of change of political policy is where you used to see the alternative investment and managers would turn up at crypto conferences, crypto curious. They had a notional or a token 1% to 3% allocation, which they weren't deploying. They had it in their mandates, but they weren't deploying. I think you see them deploying money now, right, in the way that they weren't before. And so if you're a kind of asset manager who's got like a few tens of millions, now you're looking at maybe some 50s or hundreds of millions. So money's coming in the door, or the phone is ringing. And the other thing I think you see is more traditional equities and fixed income asset managers are now turning up at conferences crypto curious. So there's definitely something happening. So following your lead of, that great foundation you have in regulation and trustability, but provable trustability in a format that TradFi understands, right? Because it's not just enough to say, oh, it's on the chain and therefore it's verifiable. How do you see adoption both now and perhaps in the next 12 months?
Look, and by the way, I want to come back to tokenization too, but to answer your question, I think it gets down to regulation for the next wave of adoption of institutions, for instance. So we're a very global business, so we see it firsthand. So for instance, in Europe, with the MiCA framework, banks in Europe can get involved, and they've been making preparations to do so over the last 2 years. We at Bitstamp have a white label offering that enables a bank or a fintech company, for instance, to enable their customers to buy and sell crypto in a turnkey way. We've got all the licenses, we have the full tech stack, et cetera, et cetera. And the reason that that's important is because obviously if you're a bank, you don't want your depositors leaving your ecosystem to buy Bitcoin, but you're not going to build it at this stage. So partnering with a company like Bitstamp is important. In the US, banks still today can't go near crypto, and they're still trying to figure it out even after the change in administration. But once we get that regulatory clarity, more banks and more of those very regulated institutions will come in. So what's the driver? It's regulation. Wherever the regulation becomes clearer, then institutions can participate. And by the way, I think the media sometimes portrays, in the US anyway, they portray the crypto industry as advocating for lighter regulation or less regulation, and that President Trump is going to deliver lighter, softer regulation. I will say, from our standpoint, that is not the case. For Bitstamp and for many in the industry, we want clear regulation. We don't want light regulation. We want it clear, adequate, safe, trusted. And in the U.S., it's been a gap. So President Trump has said he's going to address it. He appears to be taking the right steps.
Oh, cool. And then you wanted to mention tokenization, yeah.
Well, it's such a great concept, and it's quite staggering, the opportunity associated with tokenization. And it's a word that refers to a lot of things, but the way I think about it is it's got the ability to further democratize a lot of markets. So there are certain types of investments that if you're an average citizen, you don't have access to. Like if I wanted to invest in some real estate venture, a parking garage or something, I don't know how to do that. There's no easy access point for me. But when that investment opportunity gets tokenized and can be bought and sold on any venue, as long as you're a qualified participant, that's quite exciting. And the other use case that we're looking at for tokenization is collateral, right? So there's a lot of ways you can use tokenized securities to enable you to take advantage of opportunities on exchanges, for instance, or in other investments via collateral. So there's a whole world of opportunity there. It's something that we're quite focused on.
So on that topic of the tokenized somethings or yield-bearing somethings, because they're not quite stable coins, they're not quite securities, they're not quite deposits, however you look at them. One of the challenges, I think, is in the mixed messaging or the mixed understanding of them. So, for example, if you look at them as investment vehicles, they look more like private placements than they do liquid securities. And so it's hard to pitch them as a trusted liquid AAA security when they look more like a kind of privately placed product. When you look at them as stable coins, they're not stable because they pay yield. Yeah, their price fluctuates based upon relative, interest yields or interest rates. When you look at the collateral or yield-bearing collateral token, that's great. And I think that is my personal opinion only. That is a great use case for them. But they're relatively inflexible or infungible because mostly it's for the buy and hold, not for the stablecoin use case, and these kind of things. There's very difficult conversation around that. What's your view on tokenized whatever's money market yields, tokenized dollars, something.
Well, there's, like I said, the possibilities are endless, but the most immediate things are exactly what you're talking about. There's the stablecoin part of the world, which has kind of become the first killer use case, is just digitizing fiat currency and using the digital version to transfer value from venue to venue, from wallet to wallet, from person to person, use as collateral, use as payments. There's just quite a level of adoption today and acceptance of stablecoins that is exciting. In the U.S., I understand there's a bill that in our Congress that is looking to put up some rules of the road around stablecoins. MICA has done this in Europe. MAS has done some of this in Singapore as well. So glad to see those rules, which will enable greater adoption. The rest of your question is where it gets can go anywhere. I mean, again, money markets and kind of the BlackRock securitized BIDL, these are all super useful for a limited set of use cases, I think. But it's what happens next, which is different types of alternative investments, I think, and different ways to enable more people to participate in markets that heretofore have been more institutional and less available to average individuals.
And yeah, so and if I may then kind of focus back in on, when you look at the announcement just yesterday, the SEC said that stablecoins or cash-backed stablecoins that don't pay interest are not securities, they're cash-like things. And by implication, although I don't think that they explicitly stated it, that interest-bearing somethings are securities, not yet fully clarified. But then doesn't that give you as an exchange the challenge that one's a security, and so it carries a whole bunch of reporting obligations and or regulatory obligations, and one's not? And so, I know it's only been since yesterday, but if you only
no, yeah, absolutely. And I mean, the way you describe is exactly right. So for any such tokens that are classified as securities in the U.S., it requires a very significant licensing, regime, and obviously set of rules and reporting that is not trivial, right? The question I have about that is like, do interest-bearing stable coins really fit that definition? I think it's not clear yet, and if so, what role are they going to play that I can't already realize some other way? So I think there's a lot to play out here yet in the U.S. anyway. In Europe, things are a bit clearer, given the MiCA framework, which is not a perfect regulatory framework, but it's a very good regulatory framework in that it delivers a level of clarity, as I mentioned, that is lacking in some other jurisdictions.
Right. Interesting times.
Yeah, crazy.
You were on the panel before.
Yes.
Thank you very much for your contribution to this kind of broader narrative and debate about where the industry's going. Other than that, Liquidity Summit, what you hope to achieve, who do you want to meet? Like I say, give us your reflections on the event.
Well, firstly, for me and for people who have roles like me, where you're kind of in the heat of battle all the time, and you're managing a lot of initiatives across a lot of jurisdictions, it's exciting to be here where there are so many institutional players coming together. And frankly, I feed off the energy a bit, particularly in Asia. Right? In Asia, there's also a level of clarity and commitment to this industry that doesn't exist everywhere. So I'm just pleased, first of all, to meet more institutional players and to take advantage of the momentum that I'm feeling here. So that's the first thing I would say. The second thing is, we have a great relationship with LTP. We're very pleased to be a part of their ecosystem, and we'll do anything to support Jack and the team. And finally, I'll say, like, many of our customers and prospects are here. So for me and the role that I play, I can get a lot of work done.
Great. Well, thank you so much for your time, Bobby from Bitstamp. I really appreciate you coming and talking to us today. Okay, thank you.
Take care. And cut. Was that approximately what you were looking for?
Yeah, exactly.
Great.
Good chat around the whole market, but nothing too specific, but good content.
Yeah.
We'll post on the Attendees website. There might be some post-production.
采访这里拿了三个是吧？他拿了一个过来。
after 1 because we will kick off at 1:20 with Kevin from Gate.io. So it's going to be a very exciting time. Lots of action here on the main stage this afternoon. I'm Andrew Work. I'll see you back here in an hour. Thank you. Thank you very much, ladies and gentlemen. We are going to be launching the action on stage here at Liquidity 2025 in just a few moments. So please make your way to the big tent, the main stage at Liquidity 2025. Sounds good, guys. Thank you. Thank you. Yep. When I hear my cue, off I go. You have a cue down there. My musical cue. Musical. Pavlov. They ring the bell, and I'm what? What? All good.
Yeah, it's good. Yeah. How much of this sort of MC stuff do you do? Do you do?
Use high season, low season.
Yeah.
I'll do this one. This one until 2049 this month.
You're going to Dubai?
Yeah.
Okay. Right.
Yeah. I mean, April, May, June, maybe twice a month. July, August, zero.
Yeah.
I'm doing one in July this for this kind of thing. Good fun.
Yeah, you're earning money. Yeah, good job.
My pleasure. No, I did last year as well. It's all good. Thanks. Excellent. All right.
Just need to get everybody back.
Yeah. Let's get some more people in this room. I'm ready anytime. Oh yeah, we are back, people of Liquidity 2025. We had a high energy morning and we are accelerating into this afternoon. We are bringing you the insights on the stage about how we are going to drive the convergence of CeFi and DeFi, how we are going to build the future, build the regulatory environment, lay down the technological infrastructure that we need to move this game forward. I know a lot of you were energized by what you heard this morning. If you would like to follow in Putonghua, we also have translation devices all lined up here at the front, in the second row. So if you want Putonghua, come on down and grab some of our translation devices. Remember, hashtag Liquidity 2025 if you're taking pictures, if you want to get caught up on the action later. And many of our speakers are doing interviews with the LTP team that will be on their platforms. Look for LinkedIn first, also Twitter and YouTube at LTP_Prime Broker. So that's where the action's happening, and it's happening on this stage. Our first speaker of the afternoon is somebody who cut his teeth in traditional finance, lined up with some of the big names like BNP Paribas, Macquarie, JP Morgan Chase, so he knows his stuff. But he's also got some of that startup spirit and startup expertise. He launched Yelp in Hong Kong, but in 2013, he saw the future, and he knew the future was crypto and digital assets. He ran the sales trading desk for the first SFC licensed digital asset trading operation in Hong Kong, really way out there in front. Today, he is the Chief Business Officer for Gate.io. He came to them as the CEO for Hong Kong, Gate.hk, but he's been promoted. He commands the world now, and he's coming here to command this stage. Ladies and gentlemen, please, big round Liquidity 2025 welcome for Kevin Lee. Kevin, come on, let's do this. Ah!
How's everyone?
Hey.
You guys enjoy your lunch? Yeah, it's okay. Sit down. Yeah, stop your clapping. It's fine. Yeah. I think this is the second time in a row that I got exactly these slots for keynote, where everyone's just half asleep after the lunch, and I'm here to task to wake you guys up. So let's get started. I've been in crypto long enough to attest to this. Crypto's never boring, not a single day. It goes up, it goes down, it goes sideways, it goes into circle, never boring. I mean, even in the bear market, it's never boring. FTX going down is enraging, but it's not boring. Gary Gensler with the significant, it's nonsensical, but it's not boring. But look at last month. What do we have? We have a whole lot of nothing. We have what, like Studio Ghibli, and that's it. This is not an unfinished slice, by the way. This is what all I have. President Trump did a digital asset address. It's 2 minutes and 30 seconds of nothing. Ethereum's upgrade, the Petra upgrades, delayed to made. We have nothing. Even today. What do you mean? Like, I got calls. Stock market's down 10%? This used to be our thing. We should be the exciting. We should have the volatility. What do you mean? Stock market's moving more than crypto market. We become the boring guys now today. So I've been here long enough to see everything's going on. There's a lot of hype. How we go this far to become what we have today? 2021, NFT was everything until they're not. DAO, everyone was in a DAO or two until they weren't. Proof of stake was great. It's the greatest things ever. That doesn't actually matter. No one talk about it anymore. The app is just like fancy website with contracts calls. Metaverse, I don't think anyone's talking about metaverse anymore. It's become all boring. What's next? We try to find more buzzwords to make things unboring. DePIN, design, everything, just make sure everything decentralized, just to have another word that's not boring. Move to earn, play to earn, sleep to earn, learn to earn. Still boring. What about SocialFi? I can't believe like SocialFi is already 2.0. Like Web is still 3.0. SocialFi is already catching up to 2.0. PayFi is the word. Sorry if my colleagues at once say. PayFi is, the name itself is already really boring. It's just like on-off ramp for the payment, which we use a different word for it, PayFi. So what happened next? In the last 6 months, the crypto god finally answered our players. As a pinnacle of unboringness in our world, we got the meme coin super cycle and we got the AI. We can talk about them all day, every day, and we'll never be boring again. What do you mean? We have a precedent that we can release a meme coin. What do you mean? Like FODCon? Like, I don't understand that. It's still around, by the way. It's, I don't know what's the market cap now, but it's a thing. Hatu, well, they're not around anymore. Even like on AI. AI is like, it was not boring at the very beginning, but then it's become a little bit more boring, so like, we have to change the name. We can't call it generative AI anymore. We have to find something new. What about AI agents? That's good, but we need something better. What about divine? It's another word for AI. It's the same thing, but we need another word to make it less boring. What about ZK machine learning? Oh, that's fancy. That's good. And what's the best of all? We put everything together. We have meme coins and AI together. We have AI meme coins. You know what happened? We got bored again. It's so boring. We don't talk about meme coins. Wait, what else can you do in meme coins like sectors? Nothing. Here's the thing. Here's the reality that we have right now. Every day, I'm talking every single day, we have 250,000 new users coming into our space. They either create a new wallet, they buy some coins, or they buy an NFTs. Who am I kidding? No one's buying NFTs these days. But they come into our markets every day, 250,000. And the new tokens, every single day, we have 60,000 new tokens created. And worst of all, you guys probably don't like it either. I don't like it. There's like 2 million tweets flying around every day talking about crypto and blockchain and Web3. This is the reality that we're in. So do the math. There will be like 50 million people in our industry alone, never actually seen the last bear market. The only thing they know is like meme coins and AI coins. There will be tokens that's created and never exchange shares anymore after the first trading days. And there will be like billions of tweets that never actually have interactions with anyone. It's just out there. We're in the deep end of the internet era where attention span is so bad, it's so short, we need bots to monitor for us. We need bots to see where the money is flowing, where's the next hypes in, and what's worse, we need more bots to monitor those bots to make things even shorter. Like everyone just like can't put things together anymore. This is where we're at. Everyone's just like about airtime. It's about liked. It's about retweet. When President Trump do this, you get the airtime. You see him doing this. When Musk jumping around like a maniac, he got the airtime. When Speak was in town, running around, overreacting to things, he got the airtime. He got on the news. I know this because I am part of this. I've been scamming you guys for likes and interactions on LinkedIn for years. Now the thing is, not everything that we do in this industry is about this absolute cinema. Funny enough, you guys come to me and really appreciate. By the way, I'm really grateful that you're saying, oh, you did a lot on LinkedIn, really quality content. But the fact is, every single time I post on LinkedIn, I spend triple the time crunching numbers at my desk, doing liquidity analysis. I like talking to you guys, by the way, but like I like numbers more. And every time you see my face rumbling on stage, there are 10 more colleagues around in Hong Kong right now, smarter than I am, more hardworking than I am, doing actual work and talking to institutional clients and talking to business partners. Every time you see Gates post something about like rebel racing in Formula One, there are people who are actually working around the clock on cybersecurity and legal and compliance team, working with law enforcement unit and regulators. And every time we do a mega event like we did last month, the Token of Love Music Festival, that's good. But also, we're fortunate enough to have an event like today, a Liquidity Summit, where we talk about something boring, but fundamentally essential and important for our industry. Now, as you all know, I can't sell Gate.io in Hong Kong. This camera, the SFC, I'm not selling anything today, by the way, on the record. But if I were to sell something today, I would have said, Gate.io has been around for 12 years. We've been through a few cycles. We've been through the bear market, bull market. So we, by itself, is a proof of resilience, etc., etc. Until someone's going to snap me back and say, well, you've been through a few cycles in 12 years. I've been through a few cycles in the last 5 days. So yes, we are at the boring end of the industry. But the thing is, the industry is never built up on degens or memes. It's about all the boring things that we do. We have people here. We have like, come on, I've been working in the field, algo trading, liquidity analysis, best executions for like 2 decades. I'm probably going to do it for a few more years. We have market makers here, prop traders. We have cloud solutions here. This is the things that connectively today, if everyone's going to post it on Twitter, we will have 4 likes and 2 comments at best. But the thing is, if the market get a little bit boring in this period, maybe it's the best signal that we ever have. Maybe it's the actual time that we can talk about this boring stuff. Maybe RWA actually worth the airtime because this is the best real-world applications for the blockchain technology. Maybe PayFi is the best mature adoptions of cryptocurrency right now. We have to take this opportunity out there, keep talking about this boring stuff. We have this once a year. This is the best conference that we have. I've been saying it last year. I've been saying it before. Then let's be boring. Hype is overrated. Hype is so yesterday. Let's be boring and let's make boring great again. Thank you.
All right, thank you so much, Kevin. Get out there. I like that. I like that energy. He's getting that message across. This is serious business, and we are going to continue doing the work. Whether we are in the spotlight or not, we are moving the game forward. We're getting ready for our first big panel of the afternoon with people who are moving the game forward. Once again, if you'd like to listen in Putonghua, please come and grab one of the translation devices. You can sit in the front row, second row. That's all good with our devices. So once again, our hashtag for this event is hashtag Liquidity 2025. Easy, right? Great panel coming up here today. They're going to be led by Yun Cai. Yun Cai is the global media head of Asia for Be In Crypto, a great platform delivering all the news that you need in the Bitcoin digital asset crypto space. We've got a double hit on the foundations, the biggest movers in the industry. Lily Liu is the president of Solana Foundation. She's going to be joined up here by Sartak Jain. Sartak is joining us today from DYDX Foundations. Alphonse Mandezi is the global head of revenue for Talos. And then rounding out this group, we've got a great one coming. I think they're just about ready to go. Yeah, okay, we're looking at them. I can't actually see them, but yes, here they come. So ladies and gentlemen, please welcome your panel led by Yun Cai on their way up. Okay, Lily Liu, you can lead the charge. Okay, here we go. Here they come. Ladies and gentlemen, big round of applause. Here they come. Everybody coming up here. And rounding it out, man, we cannot forget Sergey Bulgalov. Sergey Bulgalov, the Chief Commercial Officer for Whitebit. Big thanks to you guys for serving up lunch today upstairs. So once again, this is your panel talking aggregation and infrastructure in the CeFi and DeFi trading space. Yun Cai, the floor is yours. Take it away.
Hi, everyone. How are you feeling? Nice meeting you. Welcome to Liquidity 2025. This is Yun from Being Crypto. Today we're going to discuss CeFi and DeFi trading aggregation infrastructure. So I will let 4 of the guests here with us today, Solana Foundation and DYDX, Talos, and YB do a round of self-introduction, and then we can start the discussion.
Great. I'm Lily Liu. I'm the president of the Solana Foundation.
I'm Alphonse Bandizi, and I'm the Global Head of Revenue for Talos.
Hi there, Sarthak here from DeFi. Just a few words on DeFi. If you guys don't know, DeFi is a decentralized exchange platform, one of the largest in the space. And yeah, looking forward to talking on this panel.
Yeah, my name's Sergey. I'm Chief Commercial Officer at Whitebit. And Whitebit is one of the largest centralized crypto exchanges in Europe.
Thank you. So let's start with the first question on the infrastructure differences. So I think we've been discussing this topic for many times, but since we have very special guests here with us today, so can we start with the fundamentals? Sergey, you highlight custody, execution, and security. So can you elaborate those gaps? How is impacting institutional?
Yeah, sure. Well, I'll wear my centralized exchange hat, right? In the first place. But at the same time, in order to set the scene, I have to say that back in 2020, right, the total DeFi volume was under 1 billion, right? Just to put things into perspective. And they were struggling to clear 50 million in volume per week. So 5 years passed, right? DeFi is doing about 100 billion and 25 billion volume per week. So the DeFi infrastructure has matured and came a long way, right, since then. But at the same time, there are kind of fundamental differences when it comes to two models. So first of all is all about custody of funds, right? Obviously, the centralized exchange, you trust your funds to the exchange, right? And when it comes to DeFi, just the opposite, right? You own your funds, you own your keys, and you're kind of fully in control. The second point kind of boils down to the execution of trades. Obviously, it's a centralized order book when it comes to Whitebit, for example, right? And when it comes to DeFi, it's a different story, right? It's just the opposite from centralized exchange. And I would say that the main difference lies in the domain of who owns the custody, what is the settlement mechanism, right? What is the ease of use? Do you have a customer support? And do you have an easy on and off ramp, right? So, of course, there are kind of emerging hybrid model, but I guess we're going to touch on that a bit later.
Primary investors who
And I saw that DYDX emphasizes decentralization. How does your infrastructure address this?
No, absolutely. And I think it's a great point to talk about the differences between infrastructure between CeFi and DeFi. But I also think that it's quite important to talk about intricacies between infrastructure between different DeFi protocols. Because it's very easy for any protocol to put a wrapper of decentralization around. But I think we all need to recognize decentralization comes from different independent parties, validators, running and securing the system, which is something that us as DYDX, we take immense pride in. We have 60 validators who support the ecosystem, make the ecosystem quite secure. So I think that is also something quite important. To your point about custody, I think that's a very important point. Right now, users, when they go to centralized exchange, they have to put their faith in centralized venues. And there are incredibly amazing platforms like Whitebit who does that. But there'll always be a segment of retail crowd that would always believe in the true ethos of crypto, which has been self-custody. From day one, this is what DYDX has done, and we have kind of pushed it a level further. To your point about infrastructure, custody is one thing, but how we can further make the matching engine decentralized as well. So I think even within the DeFi ecosystem, infrastructures are quite diverse, and talking about those diverse set of infrastructure within DeFi also makes a lot of sense. And I think as we kind of debate on this panel, and we are here in this LTP's event with institutions, I think institutions are a very big backer behind it. When they back a particular protocol, I think that's from my eyes, it's a stamp of approval in the sense that this particular protocol is decentralized enough, and they're doing everything they can to match up to the level of CeFi infrastructure. It might not be there yet, but I feel it is definitely getting there, and it's there for mass adoption.
Thank you for the very insightful comments. Do you guys have anything to share, Lily, on the L4?
Yeah, I can add a little bit to that, just based off of sort of the unique perspective that we have here at Talos. So just by way of quick background, Talos, we're the largest trading technology provider to both the buy side and the sell side in the institutional market. And so we're uniquely positioned here to sort of comment on what we're seeing some of the largest buy-side institutions do, as well as sell-side institutions. From a buy-side perspective, we have clients that interact with us to gain access to the market, so that's connecting to CeFi, connecting to DeFi, connecting to custodians, exchanges, LPs, et cetera. We give them a unified interface and tools like a portfolio management system and an execution management system. On the sell side, we're working to allow our clients, who are the brokers really, whether they're retail brokers or institutional brokers, to interact with the street, meaning DeFi, CeFi, custodians, et cetera, again, but also to provide tools to their end clients to support any type of customer workflow, whether it's quoting electronically, high-touch trading, or white-labeled UIs. And so what we see primarily coming from the institutional side is that the majority of activity is happening on CeFi, right? And so while DeFi is extremely interesting and it's where we're investing and we've acquired companies to really deploy capital there, it's really opportunistic for us. And from a CeFi perspective, it provides a certain level of comfort and familiarity to those institutions. It looks a lot more like traditional markets from a regulatory perspective. The active participants all look very similar, and we can dive into this a bit later, but overall the performance and liquidity needs are there right now, and so I think until we see a dramatic increase in liquidity in DeFi from a purely institutional perspective, people coming over from TradFi into crypto, it's going to be difficult to see DeFi overtake CeFi, but it doesn't mean that that shouldn't be the path for all of us here.
And yes, in terms of DeFi maturity, let's move to the second questions. Lily, Solana is very known for the high throughput. How does Layer 1 innovation accelerate DeFi's institutional readiness?
As he was just talking about, you need liquidity and performance in order to create an attractive, robust, and suitable on-chain economy. And it's certainly true that DeFi today we have, 250 billion of, collectively 250 billion of stablecoins, and if you add up all the TVL, although I think TVL itself as a metric is deeply flawed, because it does not measure the utility, efficiency, and profitability of those assets. That's a separate conversation. But the question is, how do you actually go build that liquidity that can then over time support much deeper markets, that can support the size that institutions or just large traders support size in trades. And I think that the way that DeFi has been bootstrapped is largely through speculation up until this point. What got DeFi Summer going back in 2020 was the idea that you could mine tokens, and there's been any which way that people have been able to or been incentivized to acquire newly launched tokens, and DeFi liquidity mining was just one of them. So that helped get this whole thing off the ground, and now that's a fairly well-accepted way that new DeFi protocols will try to attract capital and user base, and maybe that'll stick, maybe that won't over time, depending on markets and how attractive they are and how they execute. But what I think is interesting about crypto generally is if you're going to be this global kind of financial infrastructure, then the use case kind of spectrum, financial use case spectrum, should not just be perp trading, should not just be CLOB, should not just be lend borrow. And I think that a lot of the kind of focus that people have these days is to accept a priori that you should be focused as application-specific infrastructure, and I think that will be the case for a number of folks out there. But I just kind of fundamentally disagree from that being what blockchain should be, and that's certainly not the perspective that we have at Solana. So I see it as rather, how do you bootstrap, for example, stablecoin depth? Well, if you have the payments ecosystem, then you're going to create on-chain demand for the infrastructure, which does not have to do with perp trading or something like that, which can then bootstrap depth that will then help a trading economy. Because ultimately, I think what we're trying to do here is create an on-chain economy that can unify the liquidity of 5.5 billion people. unifying the liquidity of 5.5 billion people does not mean that they're all going to be perp trading shitcoins, right? There are many uses of, ultimately this is just money and globally accessible, kind of universally acceptable financial rails, and all the ways that people are going to use money, trading is one of them, is going to be the full spectrum of ways that people are going to be using the infrastructure, and frankly, most of that is going to be a transactional economy. So, one of the reasons why I think that payments and stablecoins are so important and relevant right now is because they're fundamentally useful. Stablecoins are very clearly better than many methods of payment. It's instead of 1 to 3% of transaction value, it's infinitesimally, it's an infinitesimal amount. And then on top of that, instead of 1 to 3 days for a transaction to settle, you could be less than a second for something to settle. But the utility of that is not just that it's cheaper and faster, although that is first order true. It's also about building kind of long-term utility for actually using these rails. And that to me is one way that you actually build stablecoin depth that then supports, for example, the transactional economy supports the trading economy.
Yeah, I just want to add to that. I think all of the points are very valid over here. And I think the end objective should be, as Lily just said, to grow the on-chain economy. And I think just to add to that, I think what DeFi protocols should also do is remove frictions. So we talked a lot about here, what are the differences between infrastructure of CeFi and DeFi. Yes, it's true, we've talked about things like liquidity challenges, latency challenges, but at the same time, I could go as far as I argue to say that in certain aspects, DeFi infrastructure is better than CeFi infrastructure. What exactly do I mean by that when I say that? Take examples of listing as an example. We feel at DeFi that anybody should be able to come and list anything without any frictions. What it means is, again, let's say Apple, MicroStrategy, these are the kind of stocks, or even RWA, which is a big space in DeFi. We believe at DeFi and in DeFi, this is a pivotal role that we play to be able to grow this on-chain economy, as you just said. So it really depends in which area of infrastructure that you're talking about. Yes, if you're talking about infrastructure purely from a perspective of latency and high-frequency trading, sure, DeFi is not there. But is that the end objective? I would argue the end objective is retail adoption and mass adoption. Right now, I do believe that DeFi platforms such as DeFi, if you right now log into the UI, the experience would be as similar to a CeFi experience. So in that regard, I genuinely do feel that DeFi infrastructure maturity is at par or getting to par for retail and mass adoption to create that on-chain economy that you just mentioned. And I think that we are very close there, and we are getting to that stage to the comparison of the CeFi venues.
Yeah, I totally agree, even though we are leaning a bit more CeFi from our seats. The DeFi technology is absolutely there, right? The difference that we're seeing is a difference in adoption, and it's primarily just around use cases, right? If you're a retail broker, systematic traders, et cetera, maybe it's not going to make sense to be able to access and trade on DeFi for the majority of your liquidity needs, but for tail assets and other use cases, they can certainly emerge. And that's what we are seeing, is those types of players are coming in and they're being very opportunistic. They're saying, okay, great, I'm a broker. I have a client who wants to trade this tail asset. I can make 500 bips by providing them market access to Jupiter Exchange or Uniswap and effectively running an on behalf of order, charging them on the spread after from a post-trade fee perspective. So like all of these use cases are emerging. I think like we'll continue to see some constraints when it comes to adoption, but like I said, it's not a technical issue. It's more of a getting comfortable issue with local compliance teams, et cetera.
Yeah, and just want to say, I think on that point, partners like Talos and other tech platforms are crucially important, because I feel in many of these things, it's a bit of a chicken and an egg, in the sense that does the end clients ask for the liquidity first and then we provide them the connectivity to the DeFi, or it's the former? Let's provide them with the options, such as it's a frictionless economy, anybody can come and choose whichever DeFi protocol that they want, and then the liquidity will come. So I feel totally agree. I think we are on the same page of growing the overall crypto economy. Right now, we're still shy of like what a trillion, and again, that's nothing compared to the FX world and the TradFi world. So I think when it comes to supporting DeFi and protocols, I think platforms like Talos, etc., are crucial to be able to provide DeFi to the mass adoption.
Thank you, Sartek. Fully agree in terms of DeFi protocols, we need tech, but also lately we see numerous regulation compliance coming into force. How do you guys think you can, complying with all those regulations but still stay decentralized? I think all of us would like to know, not just as a media.
Sure. I think, again, somebody like a centralized exchange or somebody at total excellence with this, because they do all of the checks that they need to do to make sure that there is no nefarious party or no politically exposed person that are trading on the crypto exchanges. But again, speaking from a DeFi perspective, I think DeFi should still have some ownership of KYC and compliance. So for example, at DeFi, for example, we do everything such as geofencing, AML screening, working with platforms to make sure that there is no nefarious party or anything that that you don't want your order to match against. So I think DeFi does play a role in that. And again, talking to these institutions who are over here, they also like to put their money behind a protocol that has longevity. In crypto, and especially in DeFi, how many times we have seen there's this new shiny kid on the block. But again, when it comes to institutions and the longevity of the industry, protocols like ourselves and other protocols should certainly look into whatever aspects of compliance that we can take care of. And at DeFi, we definitely do take care of that. But I'm sure that it's, as a C5 venue, I think regulatory compliance and checks are much more stringent, I believe.
Well, I think we need to distinguish between what the protocol on the front end should be, what role the protocol on the front end should have in terms of compliance, KYC, you name it, right? There's almost an endless set of compliance regulations designed by default that way. And so, in the US, for example, there was a battle around front ends, DeFi front ends potentially having to take on all sorts of compliance burdens. That was done away with the new, recent legislation, so that's very positive. But I think, from my perspective, what a blockchain is, and aspirationally what it should be, is neutral, open source infrastructure that is asset neutral. And so asset neutral means the most vanilla, everyone loves, like a tokenized money market fund, for example. Everywhere between that to very controversial financial content, if you think about assets as being financial content, then at the other extreme, you'll have probably some of the meme coins that you've seen over the last 6 to 12 months that are deeply controversial. So then the question is, well, who should be filtering that? And in the same way that we don't think that TCP/IP should have inherent sort of compliance filters with content on the internet, and gosh, there's a whole range of controversial content out there, but instead it's filtered by the application. And so then what you can have is you can have the greatest range of assets available, content available, financial content, if you will, on this open infrastructure, and then that's going to be the role of the application to filter that for a retail audience, an institutional audience, all sorts of different audience segments. And then, I think another perspective that we, I think, do have and should have in the industry is that various kind of layers of, let's call it access, opt-in, should be independent sort of layers that can be layered on top. And so there should be, for example, attestation service, KYC identity layers that then can be more broadly integrated across different, for example, DeFi protocols at the very least, so you don't have to, do your sum-sub with Persona. There's like 10 of these different providers, scan your face so many different times. And so I think that there are different ways to kind of architect and allow diversity of different applications, and many of them will choose to be KYC'd because at the end of the day, many people do not want to be engaging with, for example, nefarious actors around the world, OFAC, for example, and many people will choose not to do that regardless of whether that is encoded in a regulatory proceeding or not.
Following what Lily just said, Sergi, I know YB operates in all the regulated markets, most of them, and what hybrid solution do you foresee in CeFi and DeFi bridging the compliance?
Yeah, sure. Well, of course, we value our licenses, right? That's why we have to comply and do all the necessary check, both on our B2B and B2C customers, right? But at the same time, you know, the requirements are evolving, and of course, we even centralized exchanges are looking to accommodate, you know, all the customer demand coming from the DeFi space, right? And for the very same reason, we launched a product called White Wallet, which is the first kind of on-chain, non-custodial wallet, which is kind of positioning us, right, and kind of is our foray into the DeFi space, if you say so, right? So this is the very same kind of hybrid model, which is kind of evolving and offering more choice and more options in order to kind of create a predictable and stable trading environment, both on the centralized and decentralized sides.
I can go next and just comment on how we're thinking about it at Talos. Like, the hybrid model is absolutely where sorry, I keep putting my hand in front of your face, is absolutely where we want to get to. But we also have to follow our client demand, right? Like right now, we're trying to usher in the next trillion of assets coming into crypto, the next billion retail users, right? And we're working with the providers that ultimately have those captive user bases or those dollars to deploy. And put yourselves in the shoes of a risk officer at one of those firms, right? You can say, hey, there's this CeFi thing, they have exchanges, they have qualified custodians, there's banks, like everything fits into a very familiar framework that is akin to what we're all used to from a TradFi perspective. And while we don't have the clear guidance there, it does make it easy for them to draw the parallel and say, okay, it's most likely going to look like a securities regulatory framework or a commodities regulatory framework. And so I'm less likely to get fired by saying, okay, go through the standard KYC, AML policies, get your QC, get set up, et cetera. That brings a ton of constraints when it comes to the actual offerings that you can then bring to your direct clients. And I think that will ultimately be what pulls a lot of those players towards DeFi in the future. But for right now, they're just a little bit stuck from that perspective. On the flip side, when it comes to CeFi, DeFi, hybrid, tools, we're kind of already starting to see this, and you were alluding to this with stablecoins and settlement. Like, all of the trading on Talos is settled on chain, right? And increasingly, we're seeing people on Talos source yield on chain, and they're starting to trade DeFi on chain as part of their standard strategies. Everyone's staking via Talos or through partners of Talos, and we're really focused on the post-trade side of things when it comes to incorporating DeFi and on-chain management here at Talos. I think like the actual trading component remains to be seen, whether the sort of throughput can ultimately get there and latency can get there. I'm confident it will, but I think it just remains to be an area where we're going to follow the demand.
I think just want to add to that. I think, as you said, everything is ultimately client-driven and driven by what the crypto community wants in general. I think I personally definitely foresee a world where tomorrow you might be able to onboard and KYC via Whitebit, use Whitebit for your execution, but within the Whitebit wallet system, you have accessibility to different DeFi protocols and exchanges like DYDX. Why is that good? It is good because then exchanges like Whitebit or other centralized exchange can still ring-fence their users, and users will still prefer to work with them because of whatever reasons. Could be customer service, could be a range of coins, but they can still benefit from the core ethos of crypto, which is accessibility across a wide range of protocols and having self-custody. So I personally think right now, I mean, when crypto started, there was no such word as CeFi or DeFi. I personally think if we were to succeed, ultimately the line between CeFi, DeFi, and even fintech will ultimately blur, and it's going to be up to the user to be able to have frictionless accessibility to the protocols and the apps that they want to be able to access and connect to.
I agree with that. I think at the end of the day, whether it's CeFi, DeFi, various terms around this, they're different ways to talk about infrastructure to ultimately get to best trade execution. And trade execution is a function of liquidity, and, well, performance is also a necessary condition. And what I think that crypto eventually does and will do is, once you have better infrastructure being built out, that's one of the things that we're trying to do with L1 blockchain kind of performance, capability, robustness, so on and so forth, is to enable the liquidity of 5.5 billion people to be on chain in one unified venue. And no matter how deep you would even consider any one venue in the United States, for example, NYSE here, NASDAQ, typically held up as being the deepest markets, there's no market that can be deeper than shared infrastructure for the money of 5.5 billion people. And ultimately, we have many phases of maturity to graduate in order to get to that place where it's really competitive. With more traditional venues, but ultimately, when you have that, if you have a diverse retail audience, then the institutions will also come to that, because that's what they provide and trade liquidity against. It's retail flow. That's always the case. There's nothing inherently nefarious about that as well. I know it oftentimes gets characterized like that, but retail needs institutions, institutions need retail. And then I think the other kind of value proposition of crypto, while the performance of the infrastructure is trying to catch up over time, is what is unique. What's unique is that there's going to be more assets you can get on chain than you can get through any broker, through any brokerage platform like a Schwab or even a Fidelity. So there's going to be a broader range of assets, especially with tokenization, because what tokenization is going to do, it's going to take many of those assets and actually make them available on chain. And so you're going to have a broader range of assets and also a broader range of ways to use those assets productively. And so I think one simple example is the ability to collateralize a tokenized asset where, let's say I can buy a money market fund today, and I do on Charles Schwab. If I buy $100,000 of a money market fund, the thing is, if I wanted to, well, let's not say money market fund like this, I'm going to buy like QQQ or something like that. If I wanted to collateralize QQQ, how do I do that? Well, I can't really. But if I had a tokenized form of something like that, and I wanted to borrow you in conservative LTV against that 20%, that's the type of thing you can execute in a very short period of time on chain. And even for a traditional investor, that has an immediate value proposition that is not available in any TradFi rails. So I think that even as we get to the very sort of high performance required financial use cases, which are typically around trading, which is very relevant to this group, that is the most performance oriented kind of like set of venues in the financial ecosystem. And I think while core infrastructure tries to catch up with that, in the near term, there's all these other sort of value-added ways that you can use our assets that you just can't do in the traditional world, and those are going to be the things that drive demand in the medium term.
Amazing, guys. One last question. Talking about all the unpredictable futures and DeFi and CeFi, what do you guys think actually retail investors can contribute to the mass adoption of Web3?
Do you want to go first? Okay, I'll just a quick point, and I liked what Lily said, which is it's often perceived nefarious if institutions are trading against retail, but I agree, there's nothing nefarious against that. And I just want to say one thing. I feel building liquidity is like building a giant Lego block. You can't just have all small blocks, let's just say retail, or all giant block all together. Building liquidity is like, imagine building a giant sculpture of Legos. So yes, you need both institutions and retail to work together to be able to build that liquidity. That is just sort of the simple-minded synonym that I try to put in my own head, and just wanted to share that with the crowd.
Yeah, I mean, I think like crypto has always been a retail and community-driven market, right? Like all of the innovation to date has come from retail demand for the most part, and I don't see that necessarily changing. I think you're going to continue to see the largest retail brokers look to support more and more coins, and the only way to do that may be to source that liquidity from DeFi eventually, right? Or like, I mean, how many users were onboarded during, like the Trump meme coin launches, right? Like a lot of users, that was their first experience with crypto. They got excited and they figured out how to set up wallets and trade on Solana. Like that was an incredible onboarding exercise. It didn't happen through a large, retail broker. It happened directly on chain, and I think that's exactly the type of movement that is going to keep pushing this industry forward, and people have to take note of that.
I mean, retail and institutional, it oftentimes gets characterized as being, like the shark eating the fish, and I also would not characterize it as working together. Like, let's be clear, it's adversarial, and institution is making ARB and BIPs off of retail. Now, the reason why retail's into it is because they can still have access to assets and financial kind of like upside they wouldn't have otherwise. If you look at a business like Robinhood, market makers are, and Robinhood as a platform itself, making gobs of money off of that. Retail still loves it because they're able to trade same-day options and do things that your parents probably wouldn't advise, but they're into it. And so I think retail institutional, it is inherently adversarial, and they're inherently, institutions inherently profiting off of that. But at the same time, they're providing a valuable service, and I don't think there's anything inherently wrong with that, right? To characterize that as being inherently problematic in some way is just frankly an anti-capitalist viewpoint.
Yeah, I cannot agree more, but I think the end goal here is to basically build a seamless, accessible, and very efficient financial ecosystem, right? And I think all the industry players has to kind of join forces, in order to kind of move things in the right direction, despite all the pros and cons, despite all the existing inefficiencies, right? In order to make both centralized and decentralized models work together for the benefit of the end customer.
Definitely. As a media, we love to work with companies with long-term visions that, like all of you guys, I think we are going through a very volatile time, especially currently. So we should all stick together and focus on the future together as a community. And our panel has finished now. Our time's up. Thank you so much for the insightful discussion. Thank you guys for joining us today.
Thank you.
All right, thank you very much to Yun, Sergey, and the rest of our panel. You guys have done a great job today. Well-earned rest, and maybe even a cocktail later on tonight. Yeah, I can tell you're up for that, Alphonse. Fantastic. Thanks, Lily. Thank you, Yun. In the beginning, there was custody. And we've done custody, but now we need advanced custodial solutions, and they are going to evolve in the current and future regulatory environment. But how exactly is that going to work? We are going to find out right now up here on stage with our next panel that is going to be led by Helen Ye, the CEO of Qubit. She's going to be coming up here with Simon Copper Morgan. Why do I put the Copper in his middle name? Because he is not only the Chief Commercial Officer for Copper Securities, but he is also the Head of Global Revenue for Copper, the mothership. So we're glad to have him up here with Jude Tsu. Jude is the Director of International Business for Fireblocks, so he's going to get ready to light a little fire right up here on our stage. Takatashi Shibayama is the head of APAC for one of the OGs of custody, Ledger Enterprises. So very excited to have him coming up here on this stage. I think, Helen, is your team ready to go? Fantastic. Let's get those guys coming up here now. I know we've got one more to round out this group. Here they come. There we go. I've got Helen. Fantastic. There we go. Everybody coming on up. I've got Dude and one more. There we go. Thank you very much. They're going to be joined today, rounding it out, one of the biggest players ever in the crypto market from Binance. We have Joy Lam, who is not only the head of global regulatory affairs, but also their head of legal for APAC and one of the world's rising stars in the legal firm. So with that, let's take it away. Helen, all yours.
Thank you. Good afternoon, everybody. Today, we are going to sit here with my panelists talking about custody, and it's more talking about operational challenges as well as regulatory challenges here. But also, more importantly, it's probably talking about opportunities laying ahead for institutional adoption. Now, with further ado, I think today the discussion cannot come with a better timing. It's probably more urgent timing. Last week, we all heard about this allegation against the First Digital as the trustee of TUSD. Now, reportedly there was a mismanagement of the escrow account or client money. So with that, there's a lot of ripple in the market. In particular, some of the local newspapers, Dim Sum Daily, actually cited the comments from lawmakers, Johnny Ng, who is now calling out for some of the regulatory lack of specific regulatories for digital asset custodies. Now, I would like to start from there, and obviously, if you don't mind, I would like to start from Joyce, and for you to comment as the global head for regulatory affairs for Binance. When you look at globally, the landscape for regulatory, do you see a fragmented approach? Because as Hong Kong, Singapore, Australia, opportunity for the industry to work together and to create a more viable and adaptable regulatory environment.
Thanks, Helen. Great question. Definitely very topical. I think it's certainly the issue of fragmentation versus harmonization is something which is being discussed quite a lot. And I think we are not where we need to be, but I think it's a journey. I mean, I think if you look at the industry in general, right, it's still quite young. It's still nascent, and I think that in the last 5 or 6 years, we've seen very, very significant evolution in the regulatory landscape. We've gone from no regulation to AML-based regulation, now to robust frameworks. But different countries, different regulators, they're at a different stage of that journey. And so I think what we're starting to see is more regulators kind of embracing it and really getting to grips, I guess, with some of the unique features and challenges of the asset class, but also an understanding, I think, of regulators of really the global and borderless nature of the asset. So, I think what we've seen, at the beginning of this is, I think, regulators taking a very sort of domestic and inward-looking approach, and I think there is starting to be more recognition now that actually, if everyone takes the domestic and inward-looking approach, it just doesn't work, because that's not how the asset, is by nature, and the way that people use it, and the way that market participants actually operate. It's very different from TradFi in that sense. So I think there is an understanding that there has to be more harmonization, and I think that you've got global bodies like FATF and IOSCO and the FSB. They all have a role to play when it comes to setting the international standards, and then it's up to each international regulator, I guess, to adopt those and to apply those into their own frameworks. But in addition to that, I think there is, and as I said, this recognition that actually the regulators need to figure out a way to work together to ensure that we have a level playing field and to ensure that we have consistency, which is important for the market participants, but it's also really important for users ultimately, because I think it's very challenging for users to understand sometimes what they should be looking for, because they may not know, what is the different regime with different countries, and what are the, indicia that they should be looking for when they are selecting the counterparties that they are working with. So I think, it's a journey, and we're not there yet, but we're moving in the right direction.
Thanks, Joy. I do want to have a follow-up on that. As you correctly pointed out, I think traditional financial services are very localized, and partially because of the market they serve, partially because of regulation. But digital assets company or industries are global from the very beginning. Cross-border payments is the essential part of it. So from that perspective, if we think about this, right, everybody sitting here on my panel, you are all managing an international business. And now you talked about when customers actually from different jurisdictions are looking for different things. So my next question probably is to Simon. As you are managing your solution is deployed globally and in very different jurisdictions and servicing clients under different regulations. So do you find this approach fragmented or not on the level playground sort of approach really affecting your clients and your business? Do you find that challenging?
There's no question it's challenging. Regulatory arbitrage has always been a thing, even in traditional financial services, and I don't really see this space as being any different. I'm a UK native, as you can probably hear, and I find it very, very frustrating that UK didn't take the lead when it had the chance. And what is quite clearly going to happen now is, with the current presidency, regardless of his tariff agenda, is undoubtedly going to lead the US to be a regulatory environment which is going to be welcoming for our type of businesses. So it's very important, and we are pursuing licenses over there. But to your earlier point, the fact that the UAE has done very well, I reside in Abu Dhabi, we are regulated under ADGM. The fact that they have created such progressive frameworks, whether it be VARA or the FSRA, and unlike the rest of the world, as far as I can tell, are open to dialogue and open to understand what our businesses need and require to operate correctly. And that's why they've seen a lot of success. All of that said, with MiCA coming in, it's very important that we get a license there. So we have now one in Liechtenstein, which gives us access for MiCA. And we have a license in Switzerland where we operate our main business from. We also have a trust license here in Hong Kong. But ultimately, we need as many licenses globally as possible. But I do think it's quite clear that as the years progress over the next 18 months, the US is going to be where we need to be. We're very focused on that. But as I say, all our licenses around the globe are very, very important. But yeah, it is undoubtedly a big challenge, I think, for anybody operating in this industry, because the goalposts continue to move. And all you need is clarity and consistency. And I do think that's what the UAE has given as a sort of a leader at the moment.
So I do want to actually answer you the next question. Obviously, you know, for Joyce's business or actually for Simon's business, they are operating a compliance model. It's technology solution provider. As a solution provider, do you also have the same challenge across different jurisdictions? Where do you see, as you know, Fireblocks as the largest technology solution provider, where do you currently see the biggest challenge?
Thanks, Helen. I mean, earlier in your question, you mentioned the interesting keyword harmonization. Yeah. I was really hoping the tariff situation can be harmonized, but life goes on. And in our view as a technology provider, we believe it's not a process, you know, across different jurisdictions to look for bare minimum. It should be a process of looking for bare maximum, right? And how do I mean by that? Is, you know, for the Bitcoins I bought in Hong Kong versus the Bitcoins that's being sold in Dubai, it's the same underlying asset. It exists on the same blockchain. The only difference then is how these operators or the sellers in these different jurisdictions are being governed. What's the policy look like? What kind of disaster recovery processes they could have. So I want to draw an example from, say, DORA. That's the latest regulatory change we have seen so far in European Union. It was enforced in January. Full term stands for Digital Operational Resilience Act, right? And within this DORA Act, there's a very specific section describes requiring the FIs as well as the CASP to be prepared and respond to technology failures and attacks. And that, to me, is the bare maximum. Just how do you prepare for the worst-case scenarios? And if that happens, what's your fail-safe? And that's where Fireblocks has been holding our standards to. Let's be prepared for the worst-case scenario. Just my 2 cents.
Sure. Now, we're talking about the technology, well, the regulatory maximum versus the minimum. Now, I think that probably will be a very good question for Taka-san, because obviously, you know, Ledger was under the spotlight, you know, a few weeks ago, and that is exactly what we're talking about, the maximum versus the minimum. So, is there anything that going through that entire process? I'm sure you had a lot of to share or not being able to share, but going through that process, do you see something you think the regulators should put their efforts on versus they are actually looking elsewhere where you feel it's just because they don't understand technology, so they focus too much on something they really shouldn't focusing on?
Yeah, I think what we realized during that incident is that the said exchange was using a pair of retail products for running in a very institutional business. And when I say retail products, I'm talking about particularly Ledger's product, which is the cheapest end of our retail product. And basically, the product has moved on. You know, the main problem with that issue, and I'm sure everybody knows this by now, but it was a UI hack, and what the address was showing on the UI was different from where it was actually going. So if they were using Ledger Nanos for that, they wouldn't be able to confirm it on that device because it's called blind signing. Our retail product has moved on since then. That you can see, it's basically like a e-book, sort of say. And then you can see all the transaction data on it, and you can see exactly where those funds are going. So they could have, reconciled what they saw on the UI versus what they see on the personal device that they're holding. So that could have been rectified. I wouldn't say it's a technology failure, but it's more of a human error, right? Their choice of using retail products to run an institutional business, and then wrapped around that, how would the regulators actually know that this was a right product for this company to use? I'm sure they went through various regulators to get their licenses. I'm sure they have shown that they were using safe wallets, their Ledger's retail product, and they still got a thumbs up from the regulators. So we can't really expect the regulators to actually know the technologies that we have because we're so much more advanced than their knowledge, and also traditional custodians don't play in the same field, so they don't have anything to take examples from. So part of it is like for us to continue to provide the technology ready for regulators to accept, but also at the same time we have to be speaking to regulators to keep their knowledge base at high levels as possible.
There's something that you actually mentioned that I find it quite interesting is the technology actually changes very fast. Obviously, people working in the crypto industry, they always feel like I've done a lot, right? I heard that comment from Joyce as well. Now, with this rapid development of technology, obviously, there are things that, we're looking for the next thing. We're always looking for the next thing. I remember many years ago when I first started underwriting the crypto risk, or in particular, the custody risks, we actually put a cold wallet on the separate policy form versus the hot wallet. And eventually, there started to become, it's very difficult to tell whether it is a cold wallet versus a hot wallet, right? And now, as the professional institutions, right, they are trying to adapt into the crypto world, then they are looking for institutional grade of solutions that would require the traditional bank grade of security, but also with native blockchain level of flexibility, and will require you to have more product features. So, for example, you have cold and versus hot. How do you connect them seamlessly in order to improve your efficiency, operating efficiency? Do you support staking? Do you support CeFi, DeFi interface? And is there any other features like supporting tokenization, for example, on-ramp, off-ramp? So in your own experience, everybody sitting here, deploying technology, deploying solutions, where do you see this infrastructure development in the next, I would say, 18 to maybe 3 years of time? Where do you see the next breakthrough?
Do you want me to go first?
Sure.
Look, an awful lot has happened in the last 2 years alone. I don't want to speak for Jude, but I believe fully that we have the best technology out there because we both use MPC, and that's the same with the people at Cefu as well. And for me, of course, security is the number one thing when you look at a custodian. I actually talk about copper these days not so much as a custodian. Of course, our infrastructure is built on custody, but we're much more a collateral manager and a credit risk mitigation business. And that's where I think the real solutions start to come in. It's all well and good, some of our competitors saying we have assets locked away in cold storage, but if it takes you 24 hours to move the asset, it's a waste of time, frankly. The whole point of this industry is blockchain. Regardless of crypto, it's blockchain and how you make financial services better. You're only going to make financial services better through speed and collateral mobility. And in order to do that, you need solutions like MPC, where you can actually move assets quickly. We can sign something out of cold storage in under 5 minutes. Now, that is a very different proposition to 24 hours. And I don't see the point of having a solution where you don't have that ability to move collateral. Clearleap is our biggest product by a mile, and I'll probably bore you all senseless about it later, but it's really important to us that those assets sit in cold storage within the Clearleap infrastructure, but we're able to move the collateral and therefore settle versus our exchange partners very, very frequently, every hour or every 2 hours. And that enables you to constantly bring down risk in this system. Now, the biggest challenge is us getting that idea out there, not only to clients, but also to regulators. I think it's a huge, huge thing that blockchain can achieve, and they actually don't understand it yet, but we're starting to have these conversations. You know, this industry is unique in the fact that assets trade 24/7, 365. Again, I will say it again, we settle every 2 hours, 24/7, 365, whether it's 2 in the morning on a Sunday, 3 o'clock on a Monday, it doesn't matter to us. Now that becomes really important when you have a situation like we have today. Friday, a huge amount of risk is built up over the weekend, markets open 10% lower, they gap lower. Every risk department in the world right now is having a conversation, what the hell are we going to do? Every trading desk is probably panicking. My point is, if those assets are traded over the weekend and risk is settled every 2 hours, you don't get these big seismic moves. And I would suggest you wouldn't get these Black Swan, Black Monday potential events, which I hope we're not going to have. So I think there's a huge amount of development that's already happened. I would argue we're at the forefront of that. These guys undoubtedly are too. But it's collateral mobility is the key to this industry. Otherwise, I think we're wasting our time.
Yeah, I think also everything becoming on-chain is probably the next part of this evolution, because right now I think a lot of things are still run off-chain. Settlements are run off-chain. Settlement instructions are run off-chain. You know, I think these things need to come on-chain as well. I think that's the next evolution. I've been a proponent of segregating duties, right? I mean, we talked about regulators. I'm very surprised that they allow exchanges to become also clearing houses and custodians, right? Those things have to be separated. And once those are separated, all the settlement instructions should come on chain to be done through cold wallet solutions. I think that's kind of the next phase that we should be looking at.
And perhaps I can add a little bit more. You mentioned the interesting word again, right? Evolution. If you look at 2024, the crypto user base grew by 40 million. But at the same time, the number of cyber attacks also reached all-time high of 303, right? Resulting in $2.2 billion lost, right? So what I'm saying here is that with the adoptions, with the user base growing, the attacks are growing as well. So the evolution of crypto custody should never forget what's the core competency. It's always about security. It's about your money safety, right? Hence, in a way, how we see the defense can be is always being paranoid. Just assuming the attacks can happen, and how do we defend against that? Design mechanics to prevent that. But for safety, again, it's a very subjective word. And in my view, again, if you look at what's considered as ultra safe, it's actually a safe house, right? You can have an online machine that serializes the transactions. Somebody takes a smart card, load up these payloads, walk through 2 doors of the safe house with your Face ID scanned, and eventually reach the air gap machine with the hardware security modules installed. And then you tap the smart card, signing happens in the machine, and then you tap the smart card again to receive the conclusions, and then you walk through the 2 doors again, and then you reach the online machine to pass the transactions on-chain. So like what Simon mentioned, it's a laborious process. You're almost like Tom Cruise in Mission Impossible just to get the transaction signed. And is it safe? It is. However, I think it's always a balancing act between security and efficiency. And never forget, though in the crypto technology industry, there are standards, right, like CCSS, ISOs, and all that. But from the attacker's perspective, there's no standard. They'll just think of any ways to infiltrate and, of course, compromise the whole setups you may have. So in that sense, again, Fireblocks is committed to always look out for all these threat vectors and actively defend it. We believe in offense is the best form of defense. But at the same time, like you said, technology is evolving. It's not just blockchain. It's also AI, for example, right? And we start seeing artificial intelligence enabled attacks that automates, that scales. And at the same time, even social engineering can be through deepfakes today. So how do we defend against that? That's something I think people are exploring.
Before we wrap up on this breakthrough, I do have a question because I think it's very rare that we have two major custody companies and Fireblocks on the same stage. You are catering to very different, well, not very different, but different types of clients, and you are looking at different markets as well. If there's one feature of your product or service that you have been working on, you believe is what the market will really need, can you share with us here what you have been working on? One thing. I'm sure there's a lot of things on your table, but one thing that you personally would like your company to get it done.
I mean, for us, it's doubling down on Clearloop. I hope most people in this audience have a brief understanding of what that is. It's known as an off-exchange settlement solution, but again, that's a term I absolutely detest. The reality is we're a collateral management credit mitigation business. So what does that mean? It means if you post assets into the Clearloop infrastructure, we are mitigating your risk versus your exchanges, and you're also mitigating your risk versus copper, because we recognise we're not JP Morgan. The point is Clearloop is a bankruptcy remote structure, so you're not taking any credit risk to us either. Now, to really expand on that, why it matters and why it matters for crypto, but beyond crypto, which is what I really think is relevant here, is when you, what we call, delegate an asset to an exchange, the exchange will mirror the asset and so on and so forth. You open a position, you start to trade. The predominant activity is derivatives, as we all know. People trade perps, options, etc. When that happens, the exchanges actually collateralize that trust. So clients are comfortable knowing that their initial margin is safe, that their open P&L is protected, and even better than that, we then settle very, very frequently. So we settle every 2 hours versus Bybit and OKX, and actually Coinbase are joining very soon, and we're going to settle every hour. Now, why does that matter? It's what I said before. Constantly, risk is being pulled down out of the system all day long, every day of the year. It doesn't matter, again, if it's 2 in the morning on a Sunday. Constantly settling. Now, that means you never get these big build-up of risk events. Again, I'm harking back to my TradFi days, but if you remember when Archegos went bust, whenever it was, 2 or 3 years ago, what ultimately led to the downfall of Credit Suisse, led to the downfall of Nomura Prime, and other primes lost billions of dollars. It's not an exact example, but the reality is, let's say it was Monday morning, the market became aware they had an issue, they had exposure to 5 stocks, those stocks started selling off. Their prime started issuing the margin calls. No surprise, no margin was delivered. A day goes by, 2 days goes by, 3 days go by, still nothing. Goldman, being Goldman, started selling down the positions. Makes the market worse for everybody else, and it led to the downfall of Credit Suisse, etc. Now, how do we solve that and make that better? It's not an exact science, but my point being, when we settle every 2 hours, if a margin call is issued, the client or the exchange has 2 settlement cycles in which to meet that margin call. So that's a further 4 hours. If they do not meet the margin call, we have the right, legally and technically, to default the exchange or default the client. And that means the initial margin can be returned and sold down. Now, if you think of that in the real world, and this is where regulators start to become a bit more interested, you suddenly start to see that the risk events never build up. And by the way, all of this is utterly transparent. You can log into what we call the transparency dashboard, where you can see the health of the Clearloop Trust at any time of the day. You can see the collateral that's been posted by the exchange. You can see margin calls issued. You can see settlements that have been made or missed. And clients and partners can make their own decisions. It ultimately acts as a red flag warning system to make sure that the market operates well. And
I think,
the Bybit
Simon,
hack
you
was
even
the
have
perfect
actually
example.
covered the last question about disaster scenario. You have painted a very grim picture here. Given the time we have, I have to move on to Jude.
Yeah, sure. As Fireblocks, I think I'm personally very excited about this feature we call the DVP, delivery versus payment. And the reason why Fireblocks is investing and launching this feature is because of client demands, right, in the OTC trades. It's always a question of trust and who initiate that transaction first. Because, before you send the assets to me, I'm always exposed to that credit risk. So we hear that demand from our institutional clients. I know our product teams are building that feature as we speak. We do have a prototype, but it's never perfect. However, we are building the more advanced version of that kind of solutions.
Taka-san?
Yes. I think by now, a lot of the custodians have now started building or built out already off-exchange solutions or collateral management solutions. Ledger's no different from that, other than the fact that we are a technology company. It's a SaaS product. It's a plug-and-play, multi-custodial. However, one of the interesting features that we can pull from our retail product, which I thought, after joining Ledger, I thought it was very fascinating, is that when you have your Ledger device and then you can trade, you can swap through those Ledger wallets, they actually don't touch the exchanges. So you can have your Binance account, you can have your Bybit account, whatever it is, plugged into your live application and be able to swap directly from there without having to pre-fund the exchanges. And that solution can be transferred over to the enterprise side, which I think would be very exciting.
It's all very exciting product features actually to come to the market, and then I'm sure everybody is very much looking forward to it. We don't have enough time, but I do have one last question to Joy. So Joy, this question is probably also because you are a woman, and women always save the world by the end of the day, is if there is one disaster scenario, right? We probably had some incidents in the past. We had FTX fall out, we had the Bybit hacking. They are incidents, but we haven't had a major, custody or a major exchange being completely infiltrated and lost all the assets. But it is not a 100% impossibility, right? So if that happens, what do you think this market will react? Are we there to deal with the situation? Do we have enough of tools? Do we have enough of mechanics? Do we have enough regulation so that when institutions come into our crypto world, they feel like there's a safety net?
Look, I think that, again, it's the journey and we're not at the destination yet. And I think, on a lot of those fronts, I think at the moment if something happened, right, there are different mechanisms and supports that you can get from several of those venues, but I wouldn't say that any single one of them is going to be robust enough to provide the protection that institutions are really going to be looking for. And I think definitely when it comes to regulation and the regulatory landscape for custody, there is certainly a lot of work to be done. And I think, if you take Hong Kong as an example, we've got the TCSP regime here. You've got a lot of custodians that also are registered as trust companies, but we don't, at this point in time anyway, have a specific regime for the custody of digital assets. And of course, that's something that is coming, but it's not there yet. So I think, in terms of the market, when we've seen incidents, we've seen that, I think the ethos of the industry in general, everyone understands, right? If one big player implodes, actually, it's not, oh yes, that's one less competitor for us. Everyone understands that is bad for the market overall. And so at the moment, we do within the industry have this sort of community sentiment, and people will sort of, work together and make sure that the industry overall isn't adversely affected in a way that would be sort of detrimental longer term. But I think really when it comes to the different mechanisms that we need to protect against that kind of situation and giving the institutions the comfort that they need to engage more, there's still, I think, progress that we can expect to come, particularly on the regulatory front.
Thank you very much. We already exceeded the time allocated to us, but one common theme we've heard repeatedly today is we have a rapidly developing industry and the services providing to the industry, but at the same time, we're calling for more robust regulatory environment everywhere in the world. Thank you very much.
Thank you.
Thank you.
All right, thank you very much, Joy. The rest of the panel. Helen Ye, you've done a great job. Thank you so much. All right, and everybody, we are going to be taking a 15-minute coffee break brought to you by our friends at Gate.io, who in February announced their sponsorship of Red Bull Motor Racing, which means that their man was at the top of the podium at Suzuka in Japan on Sunday. I was excited to see the Gate.io on Max Verstappen. With that, we've got about 15 minutes. We'll have you right back in here with more action on the main stage at Liquidity 2025. I'm Andrew Work. Thank you. charged up, Ruben?
Never.
Never, maybe.
Well, this one keeps cutting out now. It gadgets never last. I mean,
Yeah, I just changed my
it
phone.
never lasts. This one's charged. But this is actually cool. Well, just a one charge. They let you bring it on planes, and this can charge the laptop, and it will drain the hell out of it. And then you got to recharge it. So if you may not charge the laptop, you have to charge this. But this seems to charge pretty fast. This thing doesn't have a battery. This is my security. It's a 5G router, so it's like a portable router.
Okay.
So you plug the SIM card in there wherever I travel to. It works. That case in point, a friend of mine, in the US as well, he lives in LA, goes to Spain. Somebody goes nowhere, went to a conference, SIM card swap, $500,000. Crypto loan. I'm like, now people question why I do that.
Yeah.
Because it's almost impossible to do that because everything's detached. Case in point, he got scammed again online, $3 million crypto. And there's only a custody. Yeah. That's my whole stick to my fund. I don't take the risk. I've seen what happens.
That's
I mean, you're not talking 1,000, 10,000 getting scammed.
500,000. That's I mean,
he got SIM card swapping. He said he can't, you know, he was related to them. They got the SMS code. They take the money. It's really in the neighboring country over there, Cambodia and Myanmar.
I listened to that whole 8-part plus 1 series of Scam Inc. from The Economist.
Oh, that was good.
Fantastic.
That was really good.
Yeah. I mean, just the idea that it is a global industry bigger than illicit drugs, where they are constantly.
I said a few years ago, this is a Wall Street model. People are like, what do you mean? I said, you have the owner, you have the managing directors, you have the boss on the floor, the manager, and you have the underlings. The only difference is they're not working
Getting
there.
their testicles electroded.
It's all the same model. Everybody gets a cut of the franchise.
Yeah.
I said, this is a Wall Street model.
It's an asset-light network platform.
It's human capital. You burn the human capital, and you know, and if you can't handle it, we'll give your accounts to someone else, right?
Yeah.
And if you don't want to do the job,
We'll give your kidney to someone else as well.
we'll kick you out and beat you up. There's a Chinese movie.
Well, they said there's been a whole week.
Did you see this Chinese movie? I just saw it about 2 weeks ago. It was from a couple of years ago. All Bets Off or something.
Oh yeah. They made a whole route, and it was like the point always is like, other countries are bad, China good. But also, I guess, warning people, because I guess it was a reality for a lot of Chinese people. Like, if it hadn't happened to you, it happened to
They got
somebody.
scared about getting, people actually contacted my partner, and they contacted her friends, and they said, we can't come to Thailand because we heard people getting kidnapped.
Oh, when that B-list actor.
You're not being recruited, are you? You work for, a bank. They're smart people, but they hear it in the news. They're like, shit, I'm not going to go to Bangkok. It's staying at the nice hotel.
You know where people are saying about that now? Traveling to the U.S.
Oh.
Have you seen all the press about people getting locked out, rejected, and
that's not surprising.
Yeah.
You're a U.S. citizen, right?
No.
Oh, you're not. No. Canadian.
I am. Yeah, so I mean, but there's a Canadian woman who got locked up for 2 weeks. 2 weeks, it's like nothing, and then they were like, well, nothing.
It's almost, the only way you have to have, if you get locked up, you have to have someone called an attorney. That's your only, you have to.
The new one 2 days ago was an Australian, and they said, well, he got detained for 8 hours, and they turned around and put him on a flight back, and he's like, why? And they're like, we don't like your routing because you came through Hong Kong.
No way.
Yeah, he got a deal on premium economy with Cathay, so he came through Hong Kong, and when they were like, well, we don't like your routing, it's suspicious. He goes, it's Hong Kong. And they're like, yeah, go back. And that was it. So I mean, that's another one. Now all the Aussies are
interrogated in China. I thought that was bad. That was a number of years ago, but 4 years ago. But that's nothing compared to the shit going down.
Yeah. And I mean, it's just giving license to every petty bureaucrat in the TSA to just go wild. You want to be an asshole? Be an asshole. Nobody's going to stop you. So yeah, it's
power to those people then they're taking power away from the IRS and they wanted to know, get this, this is the really ridiculous, the signal game crap.
Signal 8, what's that?
Signal game.
That's a complete
military. But do you know where the signal people, that's a free platform, where they got their funding from originally? From the U.S. government, which just cut the funding. So they can't improve upon it, can they? Because you just cut the funding for it.
I guess, because I don't think it has a revenue model, does it?
It was funded by the government. The U.S. government funded a lot of things for a while, but so they're just taking the axe to everything without any. There's no due process.
That's the crazy part.
You're going to have insurrections.
Maybe. I have to admit, thought has crossed my mind.
Military insurrection, like the movie. Right, the movie.
I saw the movie.
Yeah, but you don't know what the issues were. But
They did that on purpose. Because the movie was supposed to be about journalists in a war zone. And it wasn't to say, today what is happening in American entities. They were trying to avoid that by saying, that's why they put Texas and California together. Because you're like, what? Because they didn't want you to say.
It's so vague that you were trying to figure it out. You're like, I can't figure this out.
You don't want to say.
Who is he? It's supposed to be Trump. Who is he?
Yeah, they didn't make it the coastal.
They didn't give you a feeling of what they actually did. How bad. It was weird.
My handler's giving me the look. Yeah, of course. Bring people in, build them up, get them ready. Sure.
However good the business model can be, however good your trading models can be, is always discounted. On top of that, we also provide connectivities. Okay. And what I mean by that is basically allowing these wallets to interact with your, centralized exchange trading accounts.
Okay.
Or interact with decentralized ones. Right? Or interact with your OTC counterparties for on-off ramp. And even just to interact with whitelisting addresses, maybe it's your personal address, right? So we provide that in all one box. So as a institutional player, you may operate around the globe. Sure. You don't need to manage multiple applications. And at the same time, you are able to, or rather as Fireblocks, we're able to facilitate any type of use cases you may have, right? Whether it's day 1 or day 10, you don't need to switch. Right. Hence, from a maintenance point of view, from a cost point of view, in the longer term, it's more cost effective.
Sure.
So that's what Fireblocks do.
Yeah, I think the cost effective is one of the most important things. But also the asset in terms of security is most important as well.
Yes.
Right. All right, cool. Thanks for sharing the wonderful pictures of what you guys are doing. How most importantly, how do you feel about the summit?
Oh, it's amazing. And again, thank you, LTP, for having Fireblocks here again.
Sure.
This is actually the 3rd year we're attending.
Oh, nice. Yes.
And I must say, it only gets better.
Yes.
It only gets better, and sky's the limit. And I think this time around, it's really a wonderful setup. Look at the crowds; it's insane, right? I think I don't know, my math can be wrong, but I think there's at least 1,000 people here at some point in time.
Right. You're absolutely right.
So it was really impressive. That's one in terms of crowd. And then secondly, I think in terms of the quality of the crowd, it's amazing, right? I've never met so many people in the span of, say, 2 hours at my booth, ranging from asset managers, TradFi brokers, hedge funds, new startups. It's literally full spectrum kind of client audiences we can speak and meet in just one location, one venue, and that's thanks to LTPs for organizing this.
As you mentioned, that we specialize in the digital assets, PB area, and also institutional.
Yeah.
So which means in terms of the quality of the client's quality, we're tending to be like a more professional, more sophisticated in terms of the investor or or other market participants.
Yeah.
So that's how we distinguish ourselves from the others.
Yeah, and it's very impressive.
Yeah. How do you think about the market?
Not so good for tonight.
Right. It's a long pause. It's a long pause.
Well, I mean, look, if you look at the Japan market, and we're talking about the equity markets, right, stock market, and Taiwan, they hit circuit breaker today. And I can't imagine what will happen when the US market opens tonight. Maybe there'll be a lot more volatilities.
There's a lot of volatilities, indeed.
However, coming back to your point, I think a lot of our customers, our mutual customers that we are talking about is, quant shops, high frequency traders, they actually love these kind of volatilities.
Sure.
Right? Because volatilities represents opportunities, trading opportunities especially. So I would say, from, again, the audience today that I interacted with, a few of them was very pumped about the volatility, despite, it's, minus 10%.
Never had a dull day.
Never have a dull day. Yeah. No, but yeah, I mean, of course, selfishly, I hope the market will be more calm at some point in time. But we do see there could be more events, macro events that could happen in the coming few days. So we're watching that very closely.
Last questions. If you don't mind to ask, what do you think about Trump's crypto policies? Obviously, everyone's talking about it.
Yeah,
it's quite a hot topic.
Yeah, interesting question. I think it's always a comparison.
Right.
Right. It's a comparison between what was like during the Biden administration.
Sure.
And what it like in Trump's administration. Right. And I believe in the crypto space. At least from the clients we are seeing, they feel it's a progression. Right? Because all these U.S. regulations that was barring the banks from entering into crypto has been actually removed from the executive order from Trump, and I think that is a progression. Right? Though there are other factors of the policies such as tariff that's causing the volatilities today. But I think in general, if we're looking at, say, crypto-specific regulations, we believe U.S. is now in a better state.
Sure.
Compared to previously. Yeah, of course. So I'm not a lawyer, so I think these are the comments I can provide.
Yeah, understood. Okay. Yeah, I think first of all, obviously we all agree that traders and pop shops love the volatility. And which is exactly what we're seeing in the market right now. And obviously, as I mentioned, never had a dull day in this market, which is exciting. And also, we see a lot of people from the traditional finances actually turning up recently, this year particularly. So I hope there will be the barriers between these two, TradFi and digital finances, will be actually getting more and more blurred. And they will be integrated each other's. And hopefully we'll see that day coming soon.
Yeah, absolutely. Exciting times.
Excellent. Thank you so much.
Great.
Thank you for your time.
Thank you.
Appreciate your time. Thank you.
All
right. Thank you.
All right. Thank you.
Thanks about the last minute.
No worries. No worries. I hope that was okay.
That was amazing. Yeah. We're going to send you some.
Okay.
Yeah, that's okay.
Thanks, my wife.
COVID and flu A together?
Okay.
One sec.
Okay. Welcome, Timothy from Avelicom.
Thank you for having me.
Thanks very much for coming along to Liquidity 2025. Please tell everyone a little bit about your role at Avelicom and what Avelicom's doing at the moment in digital and crypto, those kinds of things.
Sure. I'm Timothy Wong from Avelicom, so I'm the head of APAC for the company. I oversee the operation of the entire region, well, Asia Pacific, obviously. Avelicom is a low latency connectivity service provider that specializes in providing ultra low latency connectivities between major liquidity centers. That could be crypto, that could be traditional finance, but at the end of the day, we are here to provide the fastest possible connections between the exchanges for our clients.
Okay, cool. And then in terms of the market for goods and services that support market infrastructure, trading particularly, of course, presumably you have quite a deep client base that accesses traditional financial markets, so
Obviously.
equities and fixed income. How do you see their participation in digital assets? I mean, how many would you say as a percentage, or what,
It's hard to put a percentage in it, but we are seeing a growing interest. Well, actually, seeing a growing interest will be an understatement. We're seeing tremendous interest from the traditional finance world to explore the possibility of entering into the crypto world, if they haven't already entered. I would say a small percentage of our existing clients from the TradFi side has done absolutely nothing to explore the possibility to do something about crypto. Majority of them are either has already started at the very beginning stage, or at least is doing some kind of strategy testing at the back end to get things started.
Okay, and then in terms of the use case, we have low latency networks for streaming market data. We have access for basically routing around the world between the various different pools of liquidity. We may have some platforms which do smart order routing, kind of connecting across actual execution. I mean, what's the articulation that you tend to see for crypto within the network space?
Well, in our space, right? A lot of our clients would have mistaken us as a crypto firm, which we're not. We're purely a telco. So we cannot comment specifically what are they use our network for.
Okay.
But we do see a particular trend in cross-exchange arbitrage.
Okay.
Well, connections. Well, if they're not arbitraging, they obviously will not be connecting, right? Between certain points. What I could tell you is where they're going. There is an ongoing trend of, let's say, a particular exchange in Korea, where we're seeing a lot of uptick of traffics out of there. We're seeing quite a significant increase of trans-Eurasia connections between Tokyo, Hong Kong, and London for another very interesting exchange based out of London. And the other one that I could also pitch in is the growing interest in the option market. Traditionally, option is not exactly a high-frequency traded asset class, and that has been growing. And people are actually asking for faster path, not necessarily the fastest, but they're no longer happy with just the general latency path from the offered by the public internet. They want something faster, and we are seeing that as a growing trend.
Okay, and then and that's an interesting dynamic of the market. So, do you think that that is CME talks about having an option product soon, maybe CBOE. We have venues within digital assets, some well-known ones, some that have options as an adjunct to their spot market, and of course we have a very strong structured product or customized options market. Do you think it's in I'm guessing not liquid, TradFi exchanges, but do you think it's an exchange versus OTC arb, or is it just generally people wanting to get more connected at a faster level across the whole ecosystem?
I think it's just generally people want to get connected faster across the whole system. I do not believe that the crypto option market is sophisticated enough to have an OTC arb at the present time. Your company, LTP in particular, is growing rapidly and moving towards the OTC space and trying to conquer that space. And I'm seeing that you guys are doing pretty good at that front. And there are the OTC space is definitely a very interesting space to watch out for. But at the moment, in my humble opinion, it's not exactly a very sophisticated enough segment that we looked into it for arbitrage.
Okay, cool. Yeah. And then in terms of what you do, you're agnostic to whether we are a co-location-based trading activity or whether we're a cloud-based activity, because fundamentally networks is just connecting the two sources or kind of data constructs or data center constructs. But do you think that cloud-based trading matching engines versus colo-based matching, do you think it makes any difference? I mean, what do you see? How do you kind of reflect upon that?
It depends on where the crypto world wants to go. And it depends on, is this being broadcast to our cloud partner too? That's a joke aside though. The idea of having cloud-based matching machine is that smaller teams, up and coming new stars has the chance to shine with very limited resources, because cloud is just easy to get onto, it's quick, it's less resources intensive, and it's a more level playing ground for everybody, because nobody could really master intra-cloud latency, not even a cloud provider themselves. So everybody sort of have a more level playing ground when it's come to that. It's not like in the TradFi world, who has more disposable money has a better chance of winning. In the HFT world, it's always winner takes all. Like, there is no second place, right? So that's the beauty of cloud. With that being said, you would have more players. More players means that the market would move more
in cloud. You mean?
Yeah, in cloud. Yeah, the market would be moving more unexpectedly. Let's put it that way. That's the cloud side of things. But as crypto exchange grow, getting more and more mature down the road, in my humble opinion, is inevitably that they will be moving towards a more mature colo-based hardware bare metal kind of environment. I'll give you a good example. There is an exchange that is based out of Dublin on AWS. Recently announced a partnership with a hardware vendor for a bare metal colocation services, not us. It's funny that I mentioned one of our friendly competitors. Is that's a trend that is moving, and Avelicom ourselves, we're also moving towards that direction, getting ready for that next wave of change in crypto markets.
You reckon? My experience is high frequency trading broking for many, many years. And so one of the things that I observed about that dynamic was that when you have co-location, you tend to encourage activity which is not about trading the asset class, but is instead trade the network, trade the API to the matching engine, trade the matching engine logic, and trade the market, right? So it's like trade the market.
Trading.
Yeah, it's like one of four.
Yeah.
And I observe of crypto where your cloud-based activity, you're generally trading the market because latency and where the trade goes and all those kind of things in the cloud. So and the other thing I observe of co-location based markets is they tend to be cannibalistic, right? So you get an arms race in technology, winner takes all. You end up with fewer and fewer players, and as fewer and fewer players are there, less people around, they drop away. So you get less rich, less diverse risk perspectives, return perspectives, and those kinds of things. So I was generally of the my personal opinion, not that of my firm, but just my experience, is that it wouldn't be such a bad thing if we stayed on the cloud.
I would agree. Actually, to be absolutely honest with you, if I'm standing purely at the Avelicom perspective, for the best interest of my company, I would love every exchange to be on the cloud. It just enables many more players to be able to trade. The more players, the more potential clients, the merrier for us, right? That's how we look at it. but I cannot ignore the fact that the traders themselves are getting more sophisticated. They want more control. They want to be able to control down to the milliseconds. At the hardware level, they want to be able to pinpoint exactly how fast is the path between their server and the matching machine, which at the moment I can't tell you. Like, I always joke about that, right? Between our POP and the matching machines in AWS Tokyo, the range is anywhere between 1.1 to 3 milliseconds. So take your chance. But the other thing about moving towards a hardware-based, a co-location-based exchange is that you also have to look through the lens of compliance. In the TradFi world, there are many rules and many regulations. I'm not saying that crypto will not be heavily regulated down the road. At least at the present time, it is not. I give you a very good example, right? There are a number of countries on the planet where the client, the trading firm themselves can't even own a hardware legally in that country.
Indeed, I know that country well.
Yeah, which is really annoying. Yeah. And in the crypto side of things, like first, they won't pick those countries. That's for one. The other one is crypto is more flexible, put it that way, and that's what we talked about earlier is the bare metal, managed services model, where you would be able to provide some sort of hybrid solution to the smaller firms, where they adopt to the more traditional way of doing trades with a relatively more flexible and easier way to get into the market. It's cheaper, it's more flexible. It's easier for them to digest.
Scalable.
You could pull out relatively easily. Like, you're from the TradFi side of things, and you will know that if you walk into exchange, you will first need to get a broker, a rack, servers, connections. Not to mention, there are certain exchanges that will require you to have licenses, different permits to use their market data feeds. Their exchange that requires the feeds to first touch the ground within that DC before you could pull them out is just really annoying. Not to mention, there are a number of exchanges out there that requires a 24 months contract on their co-locations.
And that's right.
Yeah. So I think
market data is the same, right?
Exactly. Yeah. So I think with us providing that hybrid solution in the middle, and with the crypto exchange knowing their client crowds, they are very unlikely to be going towards that direction, even if they move away from the cloud.
Okay.
Yeah.
And do you do last mile, or you international circuits? But not the last
we do
mile?
International and last mile. We basically connect the world
in the countries where you can.
We connect.
There's a few countries which are limited, right?
So I'll give you another interesting example. There's an exchange called B3 in Brazil, which is a traditional exchange, and there has been some really interesting growing of interest in trading Bitcoin futures there, which is interesting. Because it's a TradFi market. And I see that happening for two reasons. One is while the traditional finance world is looking at DeFi, the other way is happening at the same time. The crypto native people, having their first success in the crypto world, they're looking at, joining the big boys club and try to trade TradFi world. But the mature market, like the good old CME or the LME, the HKEX, is a little too difficult for them to get started with. They're used to operating in a kind of environment where there are very little regulations and rules, right? So they struggle. They want to look for something that are more dynamic, yet is easier to get started. And B3 actually offers a very good alternative for those people to, at least start to explore and to get the first feeling of the big boys club, going through the paperwork, the KYC, getting a rack and all those good stuff, right? So it is happening right now.
Right.
Yeah.
Yeah. And then when you look at, CME, 25% initial margin, broker may mark up another 40%, 65% of notional initial margin, high barrier to entry, like you said, license all through a broker. High capital cost of investment, bare metal, all this kind of stuff. You're right. And where it's a scalable, easy entry point, get more participation, people can grow, make profit. I agree with this. It's all super
this is market structure and market efficiency, goods and services type of stuff. It's all good. Coming back to what we were talking just a little while ago about in traditional finance, there's the guys that fly around the world. They got the laptop. You know, they go to a data center. They ping the matching engine. Fly to the next city. They ping all that stuff which you see regularly in TradFi. I'm surprised how little it's being attempted. And most people say it's all in the cloud. You can never do that. You never basically get a ping map. You can't get a ping map of the world. I think you can, because simplistically, whilst there is the cloud and it is relatively variable compared to Colo, it's still deterministic, right? Machines run on code, and code is relatively constant in how it deploys. So do you think that you could create a ping map even in the web, or is my idea complete nonsense?
I think it's 50-50.
Okay.
I think it is somehow possible. As a map, I don't think that's possible.
Okay.
But to somehow try to, play around with the system to determine which path is faster, that is definitely possible. And there are a number of players out there, including the cloud provider themselves, that is currently providing those kind of services, either on the record or off the record. The old traditional way of doing it is you would have, let's say you come in, I'm going to trade, an exchange. I cannot name exchanges. Some exchange in Tokyo, right? And I would like to know, is there any route faster towards the measure machine of that particular exchange? The old way of doing it is to create multiple instances within the same zone or even different zones and just start pinging them, right? Until you find the most optimal pathway, right? But that's very time consuming and is expensive because you're creating multiple instances. And see, there are people that wins the lottery, and there are people like that's like my wife, who have played the lottery for 26 years and have not won a single buck, right? So you could be one of those people like my wife that you could keep pinging it and never get the best path. It just happens, right? So that's why it's 50-50. You might chance it and be able to find it. But I understand that there are people out there, that are from that field of expertise. They're helping clients to shape that. So at Velicom, right, it is my job to ensure that before it hits the cloud, everything is absolutely fastest by the means of submarine cable, terrestrial, or even sometimes microwaves. Depends on the need of the clients because they're expensive. That's part I will ensure. We'll also work with the cloud to make sure that they're properly being hand off and taken care of once it's off our hands.
Okay, cool. Let's shift across to DEX, DeFi, stuff like this. In theory, DeFi DEX is meant to be decentralized. It's meant to be a whole bunch of machines running separately. In reality, even with Bitcoin and other things like that, there's consolidation and there's kind of, not quite decentralized. Do you have any anecdotal evidence or general sense of, my apologies, the other data point is, what you tend to find is people doing DEX backends with CeFi front ends or something, like a yield thing on a DEX backend.
See, I won't exactly know because at the end of the day, I provide the underlying infrastructure. But
no inquiries from DAOs, no inquiries from this is my question, right?
There are DEX customers on our database, obviously, right? And you could spot them out miles away by looking at where they're asking their circuit to be handed off to.
Okay.
We all know where the traditional exchanges are, right? Tokyo, Hong Kong, Singapore, Dublin, London, Ashburn, Seoul, maybe you're following the Seoul. There are oddballs in Frankfurt and all these Zurich good places, right? But you generally understand where they are. And is when places like Seattle and Paris starts to pop up, you ask questions. I was like, okay, so what are you trying to achieve? I'm not gonna lie to you. I don't have an answer to the questions. All I'm realizing is there are a bunch of customers that is using a Velicom, requiring very low latency connections to places where there are absolutely no CeFi exchanges.
Okay.
Seattle is one of those I just mentioned.
Okay.
There are other one that I just mentioned is Paris that just happens to be being asked quite often. There are certain reasons for that, and one of the reasons I do believe is for coin validations. And yeah, certain coin issuer would have their coin validation housed in certain cloud location that is not the same location as the exchange, and they would need a fast connection to those validation points. That's one of the reasons that I see, but to be honest, I don't have answers to the questions.
Okay,
Yeah.
then I got a kind of spin of that. That question is, we're broadly puzzled by the idea that centralized exchanges have more liquidity than decentralized exchanges. And whenever you engage that topic with the degens and the hardcore chain developers and these kind of things, they all say, well, Sol, it's super fast. It can reach consensus in a minute.
Yeah.
Or others, we got this new chain and it's within a second, and these kind of things. And in my interactions with them, I say, I think one of the reasons why centralized exchanges have more liquidity than decentralized exchanges, because in centralized exchanges, even whether you have a T plus something days settlement cycle, you have an assumption of finality. The assumption of finality is provided by the broker or the exchange or the intermediary, whereas in DeFi you don't. And I think that the idea that DeFi or decentralized exchanges are atomic is not true, because Bitcoin, for example, is 10 minutes delayed on average, right? By design.
Depends.
Yeah.
Yeah.
So it's atomic in the concept of, in the relative concept of T+3.
Yeah.
But it's not atomic in the context of a centralized exchange for which finality is assumed instantaneously at trade point. So I think one of the questions might be chains, not DEXs and DeFi protocols, but chains themselves coming to people like you and saying, how can the chain get quicker? Right? It's not that they're looking at it from a centralized something point of view or decentralized exchange, but as a chain point of view. You think that's any truth in that?
That's a really, really tough question, to be honest. It really depends. Like, how much would us being millisecond faster really benefit the chain is the question. As you have earlier mentioned yourself, right? Chains are being delayed deliberately all across the world, across different platform or different protocol they're using. That millisecond latency, I just don't really see them making a big impact, globally. But if you look for the other lens of having a dedicated circuit between various points, is the stability. I think that might be something that we'll be looking at, is to add additional layer of reliability to their circuit, not only availability wise, but the overall latency figures, right? The key differences between a Velecom and traditional telcos from, the incumbents, right, is that the incumbents have no incentive to provide a latency sensitive solutions to their clients. Not that they can't. They're incumbents. They could do it if they wanted to, right? Is that they're not incentivized to do it for the simple reason of they simply don't care. When the incumbents are looking at the big pictures, right? Yeah, everybody wants to use telco. Everybody wants something. Okay, FSI, very lucrative. Financial services, lucrative. They make good money. But when you look at the grand scheme of things, they're tiny, right? So that goes back to the public internet. When you are not using a dedicated circuit between various points around the world using public internet, nothing's ever guaranteed. You could look for a certain level of certainty from incumbents. You could always do that. I've been in the telco industry for long enough to know that we promise all sort of things and fail to deliver them. It's just the telco world.
I think every industry.
Yeah, I think so too. Yeah, and in those cases, it depends on. It really depends on how reliant are you to have a very reliable network when it comes to very reliable latencies, very reliable availability. That's where the chain comes to play. Is that, let's say, a good example, right? A path between Tokyo and London, let's say, right? There are multiple ways to go across the two continents. You could go terrestrial all the way. You could route all the way down through South China Sea and then past India and then go up to the Middle East. Got sabotaged by the extremists. 3 times, 4 times a year.
Yeah,
it happens. Yeah, it happens, right? When you connect the two places without a reliable network for the public open internet, chances are your latency swing will not be a couple milliseconds. It could be 100 milliseconds, depending on your luck. Not to mention that there is a term in the traditional telco world. It's called oversubscription. That is a reason why when you subscribe to your 1 gig, go to your 1 gig fiber to home internet, you're not getting a gig because they oversubscribe the network.
Okay.
1 gig is the theoretical limitation of what you're getting, right? So basically, is that
if no one else was there,
no one else is using it, right? And it happens all the time. And once those happen, the latency just is all over the place. So I think that's where we're coming.
You've supported, I think, other events in Hong Kong. I was here from 6 months ago, a couple of years. So I've seen you guys around. You sponsor in this kind of space. And so that obviously tells us something. I guess, if I can guess, definitely in digital assets native, you have demand for sure. Question for you is, our event here, what are you looking to get out of it? Is it just digital assets native? Does it include a whole bunch of, let's say, asset managers or more traditional financial people? Like, say, what are you seeing here in the summit? Tell us why you've turned up.
LTP event is one of the very few crypto events that are purely institutional focused. You're not going to see retail people walking around, and you're not going to have door crasher that comes in that has nothing to do with crypto whatsoever. Where we're not going to name names, but some of the bigger events, obviously are going to be drawing more attention, more crowd, bigger crowds, more people. But the quality of people that walks through those doors is questionable. And LTP, at least I'm confident when I walk into this place, most of the people that I speak to would be at least, marginally relevant to what I'm trying to achieve here. And that's why I'm here. And, it's not only about, selling. It's not always about selling. It's also about learning. Coming to an event like this, where it's packed with experts from all walks of life like yourself, you learn so much more. And it helps me to feed back to my back-end team to how to shape products for the future, to better serve our customers, and to also look for the next trend. Everybody's trying to look for it. It's not only the trading teams that are looking for the new trend. We're also looking for the new trend, and we need to beat them to it. Because when they figure out the new trend, it's already too late. I need to have the infrastructure ready for them to come. So that's one of the reasons why I come as well.
Great, which makes me actually perfectly neatly to my last question, which is, of course, from a policy point of view, Hong Kong has been very, very supportive for a couple of years now, very encouraging people to come, great regulations that they put in place. Invest Hong Kong, such an amazing organization trying to bring in direct foreign investment into Hong Kong. Great. Look at MiCA. There's a definition of business framework. Some might say it's very clear, but it's too limited, right? And again, this is perhaps reflecting Europeans, more slower, more safer, more kind of bureaucratic. In the US, just 6 months ago, it was completely, prohibited and off the page. Now, very, very different. Back to your point about seeing the trends. What do you see here versus the States? Where are you preparing? Are you preparing to catch that? Change in the States. And anything that you want to say or don't want to say, please let us.
I see in the regulatory perspective, right? I don't think I'm a qualified professional to comment on it, but this will be personal view of how I see, the world in the next 10, 15 years, I think. I think there will come a time, and it will be within my lifetime. I'm pretty young, I think, within my lifetime, where the line between DeFi and TradFi will no longer exist. That's how I see it. Policy, throughout history, were not made. We're forced into. Nobody created a policy for something that is 15 years down the road. Nobody have those kind of vision, and nobody is brave enough to gamble their political career away, to fight for a policy that is not happening. So it's forced into.
Yeah.
And I think we have actually went beyond that equilibrium point, like right there recently. That's what I believe, that there is no turning back. And the policymaker are forced into adopting into a more open and sunshine policy towards the whole, the whole digital asset class as a whole globally. And I'll say within my lifetime, it will be gone. There will be no more DeFi, no more TradFi. It's just going to be one tool, and it's all digitalized.
I agree.
Yeah.
Yeah, it's an interesting. People say, does TradFi continue and remain as the incumbent?
Yeah.
Does it get washed
Yeah.
away
Sorry.
by crypto native?
Yeah.
No problem.
Yeah.
But the reality is, TradFi will become on chain.
Yeah.
They'll get much more flexible, much less rent seeking on the businesses that they do. Crypto native will become much more regulated. And we'll meet in the middle. Anyway,
Yes.
Timothy of Velicom, thank you so much.
Thank you so much for having me
at the event.
Thank you.
We're still on live stream, so as we kind of finish up, we'll kind of roll out the door. Okay. If you want to give me a. Thank you.
Thank you.
As she said, you can meet them there, but we're also, just a reminder, people are doing interviews that will be on the LTP platform. So check out their LinkedIn, their Twitter, and their YouTube, and you can see what's happening there. Our next panel is ready to go. They're going to be coming right up here on stage, and we are talking algorithms and AI and the future of trading. I think there was a time when we all thought maybe algorithms and algorithmic trading was going to put the trading floor out of business. Hasn't exactly worked out like that, even though algorithmic trading is everywhere. Artificial intelligence is in on the game now, and our panel is going to be coming up here to discuss that. Singapore got Tay-Tay, but we get Tao Tao. Tao Tao He is going to be the moderator of your panel, the head of international expansion and revenues for LTP. Right up here on stage with Erkan Kaya, who is the co-founder and CEO for Abex. Next to him is going to be Gong Lei. Gong Lei sounds like he's straight out of the movie Inception. He is a Web3 solution architect. So made me think Inception. With AWS, Amazon Web Services, the heavy of the heavies. Jackie Chung is coming up. And no, now I said Tay-Tay, you're thinking about singers, not the canto, god of songs. It's Jackie Chung, the CEO of Pulsar, who we're going to be very excited to have up here on stage. And then from the investment point of view, Millie Liu is the managing partner at First Star Ventures. And so, here they come, led by Tao Tao He, on their way up to the stage. Tao Tao, let's do it! All right. Don't be shy, come on up! Here they come. Yeah, that's what we're talking about. Take it away, guys.
Hey guys, so this panel will be about AI trading and the next frontier. At first, I would want my esteemed guests to give a brief intro about themselves and their names too.
Hi, I'm Erkan. My background is over 7.5 years in JP Morgan, building advanced trading algorithms for the options and in general equity derivatives flow. And before that, Morgan Stanley and other hedge funds and banks and stuff were similar roles. So I'm quite excited to apply this expertise and with a very strong team into the crypto environment.
Hi, hello everyone. My name is Kong Lei. I'm based in Singapore. You can call me Leo. I'm from AWS, Amazon Web Service. I'm the solution architect leader supporting global Web3 industry. And previously, I working across different cloud providers such as Google, Microsoft, and Amazon. Yeah, so I'm very excited to be here and talk about AI training.
Cool. I'm Jackie. I'm the CEO of Pulsar. So Pulsar is a market-making firm who's been trading crypto for more than 10 years, and we are one of the leading market makers. So we have been adopting the AI technologies in these few years and using it very heavily. So I think this panel should definitely help us and the audience as well.
Hey, my name is Millie Liu. I'm based in Boston. I run a venture fund called First Star Ventures. I might be the only Web2 person here today at the entire conference. We invest in AI applied to deep technical fields in very cutting-edge technologies. For example, a lot of biology, a lot of chemistry. You'll hear a lot of the nerdy stuff before you get into crypto. Before starting the fund, my background was a serial entrepreneur. One of the companies that I started is in AI. That's about 14 years ago when I was in graduate school in healthcare for medical image diagnosis, which the company now is in 25 countries, over 1,000 hospitals, and we're unicorn. Definitely do not recommend starting a business for healthcare. Very jaded from it and excited to learn more about AI and crypto today.
Sounds good. So as we know, AI has been changing the world by storm, right? We see AI in every headline around the world, but as what my former mentor said, AI is like high school love. Everyone wants it, but no one knows what it is actually too. So I first want to start off with you. So AI has been changing the world and companies have been racing to adapt to AI. So from your perspective, as someone who runs a Web2 AI fund, is which sectors do you think will be facing the biggest disruptions? And then where have you been placing your bets so far too?
I think it's actually a little bit loaded question. There's so much to unpack there for even very early or near-term stuff, right? Like if you're seeing how, for example, a lot of these vertical SaaS companies in like legal or HR, a lot of these like very junior staff, their job is pretty much being replaced. A lot of vertical SaaS companies growing, AI companies growing from 0 to 20 million ARR within 6 months. It's definitely very disruptive in the near term. That's what we're already observing. And then, for example, in the more kind of midterm, since about 2 years ago, nuclear fusion, for example, was validated. And now, like when we're scaling nuclear fusion plants, we need a lot of novel materials that doesn't exist yet. So that's where AI applied to chemistry, to material science, and also nowadays with this very uncertain geopolitical environment, space, defense, that's where you're adopting huge amount of AI. We also see a lot of things for like, say, physics or sensor technologies to observe, better observe biology samples in the lab. And then, you know, speaking like even longer term, for example, my friend who's an astrophysics professor, Peter Gallison at Harvard, he led the team that captured the black hole image. And then, you know, every day he's like, without AI, his entire team would not be able to even process from all the signal or the sensors that they put into the space. That's literally listening to every single signal that you can collect from the universe. So without AI, it's just impossible to even get through them. And then, you know, I think like maybe just leaving with the biggest disruption that I can possibly think of is my professor friend who's like, as an physicist, he never expected, but now with AI, he has the hope that he might be able to observe or see the day of time traveling within his own time lifespan. Of course, also thanks to AI for life longevity and all that. But you know, like I think that's probably like the crazy things that I can think of.
Wow, time traveling? So I guess like this is a natural question, right? So where do you see AI can change our day-to-day lives as we go forward too?
Yeah, I think as a, again, Web2 VC, there are certain things that are very long term. It's out of our 10 years of fund life, of lifespan. And there are the things that are more short term, but then it's unclear who's gonna be a winner. And then we tend to be very specific in terms of the timeline that we invest in. Typically, we look at things that can go to market within the next 3 to 5 years. So for example, AI applied to like both organic materials such as synthetic biology or inorganic materials. So for example, like for all the ladies here, I think it's already happening, but in the next 3 to 5 years, a lot of the ingredients in your skincare products, in your cosmetics products, the food that you're eating every day, it will actually be new, novel material that's derived from AI. And then, you know, speaking, since we are in the crypto panel today, or conference today, we have done a bunch of investments, for example, in geothermal, in clean energy. And, you know, geothermal is the only source of green energy outside of nuclear. And then our portfolio companies is like using geothermal where some of their clients are like hyperscalers, but then they also have a bunch of crypto mining clients. We also have a bunch of investments, for example, in weather prediction, ocean science. That's where hedge funds, I'm not exactly sure how you guys use it in crypto, but a lot of hedge funds or their strategy that's heavily relied on understanding the fundamental of energy consumption, how the weather or the climate changes the different verticals that they're investing in. They all need these very cutting edge latest weather data.
Perfect, yeah. So that a good segue to AI trading, right? As we know, during the past 2 years, AI trading has been blowing up. Now almost every fund has an AI strategy. So my next few questions will be towards Jackie and Erkin too. So exactly in the past 2 years, what were the certain triggers that caused AI trading to just blow up?
Me first. I think like the GPUs, like making it more cheaper is one way. Because like I think lots of firms are now using the AI to find the new signals, new alphas. Right? Previously, the linear models is like everybody knows how to do it already. So everybody is competing the same signal. So the signal decays very fast. So when you want to beat the market, then you need to have like some like creative ways to make things different. And then this is how AI can revolution how trading models work. Because like they can see the things that not a normal mathematicians can find out. And this somehow works very well. And then when things works well and like word spread, people just follow. And this is the trend I see is coming much faster.
Yeah, I completely agree. I think there is in the way the AI bots are operating, it's a sword with two edges, where on one side the smart machine learning driven automated trading bots taking over the execution is awesome. Then the race is about intelligence, about fast execution, about ultra low latency information, being able to process. And then it becomes things like you have behavioral arbitrage between the bots, with one bot being able to beat another bot. And then you have complexity arbitrage, then you have data arbitrage, where what these bots are processing and how quickly are they processing it. Then you have things like cross-market arbitrage, where one bots may be very frequenting one exchange because of fee structures, etc. Then you have that creates an arbitrage between exchanges. And then you have basically adversarial arm again, which is very interesting. Basically, bots tricking other bots into thinking certain market situations, then them falling into that, and then actually the other one taking advantage of that. So basically, then it's quite an advanced technology coming in. It's we call it AI arms race in the execution space.
Sounds like the Matrix, huh? Yeah. So now with everyone within AI trading, they talk about the software, the models, the signals, the edge, but very few people appreciate the infrastructure behind AI trading and also cloud computing. So my next question is to you, Leo. Since you see at AWS, how do you see, I guess, trading and also crypto clients leverage your platform and your cloud infra to meet the demands of AI-powered strategies too? And also, what has really changed in the past 2 years too?
Wow, that's a big topic. I just want to echo Jackie and you's question. Yeah, because everyone is talking about the trading is time is money, right? Fast is even faster if you want to. And so AWS has provides a lot of technical infrastructure, I think, for PowerSci and for lots of other companies in the crypto industry. So I think from the AI perspective, nowadays people are not talking about how AI can help trading policy, how we can to do the tactics. But I think today everyone is talking about how we can scale, for example, the GenAI to different line of business in the crypto market, in the quant trading, in the market makers, in the central exchange, and how we can make fast to adapt to the market, like signals, like all the microeconomics. For example, like today's, everyone's watching the stock market, right? So I think this is a dramatic change for right now, because we see that in the last 3 years, like 18 to 24 months, we have seen tremendous advances from the large language model for the GenAI perspective, from, for example, how we can to adapt the GenAI to fit for different sizes of the market, and how we can capture signals. And in the first time, we capture, for example, the market sentiments to transfer of like the decision for the trading. And so this is a very sophisticated topic. And from our perspective, we are trying to provide our best of the infrastructure for this market, because our customer demanding is very high. And this is a fun one, like Jackie talked about, the GPU for the capacity, and how we can achieve for a very high, low latency networkings between the market maker and the central exchange, and how we can capture the first hand of the information from the market. and how we can transfer the market information to input into the large language model and give it a wise decision. So this is, I think, a lot of the companies and the customers are doing so. So we offer this practice and also for our first-class infrastructure to all the clients. So this is our standpoint. Yep.
Yeah, so as you mentioned, you offer first-class infrastructure to your clients, but you also serve a wide breadth of clients. You serve Fortune 500 companies, where you serve niche trading funds, niche AI companies. So I guess so what best practices do you guys offer to your clients? Because you serve almost everyone, right? How do you have such high uptime, low latency, and so forth, and cater to every client too?
Yeah, well, I think we can define as a three perspectives. The first one is, I think everyone will think about the network and latency, because latency is the first and the most easier we can achieve. But in a deep dive, because in the traditional market, a lot of the market maker and the quant trading company are using very low latency networking. I think this is the first step. The second step is how we can capitalize the data, do the optimization, and achieve the outcome performance in the first place. So for example, Amazon has offered a broad portfolio of data solutions. For example, we're using high-performance time series database to capture the market transition and put into our big data platforms, and using big data engines to do the live streaming ingestion and do the analysis. And in the back end, we're using those time series data to ingest to our back end to the back testing. So how we can do the reactive to the markets. And in the third perspective, I think for AI perspective, because Amazon offered a platform for wide choice of the large language model. So we have, for example, nowadays everyone talking about DeepSeek. Everyone hosting DeepSeeks right now. We offer third-party solutions, open solution with the MIT license. And also we offer third-party for API access. And I think from those three perspectives, another ones everyone will be ignored or maybe not pay attention is security. Because in the first transaction market, security is still the first things you need to capture. You need to have the treat as a day zero to do the security baselines. So we have a lot of solution and practice for our customer, how it can achieve the high performance and also secure your networking, secure your data privacy, and give you the wise choice. Yep.
Wow, sounds complex. All right, so the next question that I do want to tackle on is, since Jackie and Erkan both run, I guess, AI companies, just to be broad. So what tech stack do you guys run from data ingestion to speed? What's under the hood that lets you outcompete your competitors?
Well, I think we were talking about using AI, right? I think the AIs have been really improve how our company works and how it's structured. So I mean, the very, very simple things, the co-pilot. So in a high frequency trading firm, you have lots of developers doing lots of codings, right? But now with AI helping you to do the coding, the co-piloting, it's really, really something that increases your efficiency and helps you to solve a lot of teeny tiny problems that increase your efficiency. This is one thing that is really boosts our company. And then the second thing is about how it helps the trade. I think there's lots of ways how to connect to different exchanges, and if you can use using the AI ways. I mean, I cannot say how to do it, right? But this is one of the methods we use in AI is how we can connect to the exchange with the fastest routes. It's adopting the AI.
Yeah, completely agree. I think there's two or three different parts to this question. One is, yes, we have also mandated all of our team, business team, developers, everyone, to use the latest models and the premium models, etc. But because they actually are super useful, especially coders find that the machine learning models can code as good as a junior software engineer. And that's changed over the last to 2 years when they were just about able to do a few functions okay, but not more. Now you can paste a picture onto the ChatGPT and say, do you understand this picture? It says, yes, this is the excess model, I understand it. And you say, can you generate the database models for this? Generates it. Can you write the accessor code? Generates it. Can you write the unit tests? Generates it. You copy paste, you're done. So that's a massive speed up that I think everyone should be on. The second part of the question is, how do you utilize the machine learning in the trading system? In the trading system, you need the fastest data possible in basically using the lowest latency technologies possible. Again, we use C++ only, and we have co-located connectivities, co-located connectivity to the data, to the exchanges. We check our round trip times, and we keep an eye on all of this. Additionally, in terms of the model and what you're actually fitting towards the market, what has changed recently is that how much data you can consume and how big your model can be, and basically out of that model, how accurate can you generate the signals out of. And these have made a massive difference in the recent years. So the idea is, you're trading on one side, you have the latest model in your trading engine that's basically used to create the signals, create the fair price, create the market impact models, create the order book mechanics, create all of these helpful pieces for the algorithm. But in the background, you're also consuming market data into your models, and the models are running backtests and fitting the models to be fitting the parameters for the best possible outcomes on the backtests, and then once that's actually have an accurate output, feeds into the models, feeds into the engine back again, so that the engine updates with the new model, etc. I think one of the critical pieces is to not overfit, because when you do overfit, a black swan model event will actually trip your algorithm, and it's not good. You also want to make sure the system is continuous. Like the backtesting results, you need to understand that the model is not accurate anymore, and you go back to more basic models where that's less fitted. So that's the mechanics.
All right. So it sounds like AI is about to take our jobs, right, going forward. With what Jackie mentioned, now with the Copilot, you can code much faster. As what Erkan said, now AI models, I guess Claude and ChatGPT can code better than a PhD comp sci major. So let's take a step back from the markets right now. Billy, I do want to ask you about, just what I mentioned. There's a broader anxiety about AI taking our jobs. Do you believe that the whole job market is about to be disrupted? And what can our future generations do to make sure they don't become obsolete from AI?
Yeah, for sure. So there are already a lot of jobs being disrupted. For example, we have a portfolio company that effectively replaced all the QA/QC engineers, which tend to be a third of your entire workforce if you're a tech company or if you're like software-driven company. We have a portfolio that's is actually the only one in the world right now that can do complete 100% driver out autonomous driving or autonomous trucking specifically. And then, for them, they mostly run between the California to Florida route because there's no ice on the road. So if you're a truck driver in the U.S., mostly driving from Seattle to Boston, you might be fine. But then in the next 3 to 5 years, driving from Florida to California. There is a labor shortage in the U.S. right now, especially with truck drivers. But then, for example, the companies launching soon in the Middle East or like markets here in Hong Kong, technology-wise, this is all very much solved problem. Not exactly a portfolio company, but friends company, Figure AI, for example, or all the other humanoid robot. I do think in terms of not commenting on like valuation if the actual traction has caught up with the valuation, but then Figure just, I guess I can't say it's quite confidential, but it will be closing around, which, it doesn't necessarily have more than 100 robots yet, but really their like $30 billion plus valuation round is mostly built on the premise of they are setting up a new robot factory that is going to be the humanoid robots building the next 10,000 units that they expect to receive the order from their customers. So yeah, it's definitely so happening. And then in terms of like what you can do, I think, so for example, like I think AI in itself is really not a kind of core competitive edge anymore. If you think of, for example, at MIT, where I sit on the board of the Computer Science and Artificial Intelligence Lab, although ComSci is only like one of the 20-something departments we have at MIT, but 90% of the students or undergrads at MIT, regardless if they study like biology, chemistry, physics, 90% of them all take machine learning, computer science, and AI classes. It's almost like if everyone speaks English or the language of AI, then like we may need a lot fewer translator in a sense. And then for us, we really decompose AI into kind of 3 different components, right? One is data, algorithm, and the last is computing. Well, for computing, it's more kind of commoditized where you can buy from, for example, AWS. Then like what we think a lot about what's really proprietary, what is very hard for someone else to replicate, there really comes down to 2 fronts. One is if you have the proprietary data, for example, like not the data that everyone can just scrape online, but where you have we have some portfolio companies like even they're doing kind of, it may seem that technically difficult, but then they're literally like running across different government agencies to physically collect certain data that does not live on the web. The only way you can get that data is actually through like fax right now. Unfortunately, we still live in that physical world, but at least that is the part of the world if you do get your hands on those proprietary data source, it's very hard for anyone else to catch up with. And then on the second part is the algorithm side. AI itself as an algorithm, again, that's pretty easy to catch up. But then a lot of it comes with like the deep insights. I'll give you maybe a little bit too nerdy example, but then like it's pretty easy for a computer scientist to get into protein structure prediction. But it's very hard for a computer scientist or machine learning engineer to really get into like protein binding. So these are the areas that like unless you have deep experience, industry insights, and industry knowledge, it's not what machine learning AI can easily disrupt. So yeah, that's like what we really focus on, and I think in general, like look at algorithm and proprietary data, whatever you can do that is very hard for anyone else to just replicate it within the next few months.
Wow, okay. So, Leo, so coming from your seat, I guess how has AI changed your business model as a whole, right? Because you were not serving that many AI companies probably 2-3 years ago. The demands were probably not nearly as high. So then, has there been any changes from your job, or from I guess, or maybe from your tech teams that has changed too?
Yeah, so this is, I think Gen AI right now is everywhere. It's for my personal life. Even today's morning I have a speech. Because it's in promise, but I need to using DeepSeek to generate the contents and topics for me to think about, help me to brainstorm. I think everyone can leverage your LLM agent. I think agent will be the next wave for everyone to catch the attention. Agent will become one of your assistant to change your life. That, for example, change your daily routine work and help to reply messages, help to refine your emails. So back to the algo trading, for my personal insight in here is, I think you can treat algo trading as a very complex mathematical problems. And a GPT, I think this is the first generation for classical model. But nowadays, since this year in 2025, as a DeepSeek as a representative, they represent a reasoning model, because a reasoning model is very good at solving mathematics problems. So I think this is where we take a next wave, how using the DeepSeek, such kind of this model and OpenAI O3 models to solve those problems. But nowadays we face a lot of challenges because the reasoning model take a lot of resources, and because they're using a lot of slow thinking process, they're using chain of sorts. It's not as reacting as fast as the first generation. But I think when a time is coming, most of engineering, data scientists, and even from our Amazon Web Service, we are trying to solving the slow process. We're trying to wrap it as quickly as possible. So I think in the next 6 to 12 months, you will see a fast booming from those reasoning model. It will help to come to cooperate with the, for example, for the process like the algo trading, for that such kind of to give you many benefits of that. So that will be the next battlefield, from my understanding. Yep.
Sounds good. Thank you. So, Jackie, so you run an AI quant fund, right? So I'm curious to see is how has AI shaped your trading approach today? And also most people talk about how AI quant trading doesn't work that well because it's too slow, it's too many latency problems, right? So what do you do to address all these problems going forward?
Well, I think the AI trading has been a bit disruptive, especially in my firm, because previously most of the quants are more really mathematic guys, but now it's more changing back to computer science people. So they know how to write the AIs and then learn how the AIs works. And I think it's now when we're doing AI stuff, most of them is like a black box model, right? You just give them an input and then give you an output, and you don't really know what happens and inside, but somehow it's just work. And I think this is a mindset break for you need to change how you really think about trading. It's not something, I mean, all of those linears, regressions, all those connections, it's changing. You never think that A can have an impact on B, but before. But somehow the reasoning has been changed a lot. And I think this is a mindset changing for people, especially in trading. So you need to adopt to this AI stuff to make yourself adaptive to how the world changes as well. And for retails, I think nowadays more exchange has provided more AI tools, right? They can let retails to really trade with some AI smartness. But if you want to try to beat the institution, it's not that easy, I can say, because people are really using huge money to improve their AI models, AI infrastructure. So the barriers are really quite high. Yeah. So yeah, that's what I can say.
Actually, I just want to make up to Jackie's question, because we know we have a lot of traders using the copilots, and I think just like your question previously, it's not just for solving mathematical problem, but in the future, every programmer we're using the generative AI for the developers. This is a very dramatic change, just like you mentioned, and so this is another from our observation. Yep.
Sounds good. Yeah, so it sounds like AI does have the potential to replace people, but not the top talent, I guess.
Of course.
Yeah, that makes sense. Well, hopefully we are top talent.
Yes. If I may add on to this. So as we established, I think the current ChatGPT, etc., Grok, all of these actually operate at the point of a junior software engineer, but also operate at a PhD maths level person, right? So there is the gap where junior software engineer is or more senior software engineer is the one that actually you need, and then run the mathematical backgrounds in the background with the ChatGPT gets you quite quickly to where you want to go. Yeah, for sure.
Yeah, so you run an AI-powered execution platform, and you live at the edge of execution, right? And I guess do you think AI will become more commoditized as time goes on? And how do you keep your edge, right? Yeah. Because, as you said, it's easy, quote unquote, for someone to copy your trading strategy, right? And then I guess once everyone in the same world have the same model, same infra, same data, yes, how does one compete?
Yes. So this is where it all becomes super interesting, because once you start using the similar models or same models, feeding with the same data, you have a herding impact from the bots. So for example, in exchange, someone that's actually too common to the users, providing a chatbot for you, a chat trading infrastructure for you that you can just write up something that the bot goes and trades. Well, that's probably, if you have 10 million clients on the exchange and they're all pushed to use this, maybe 5% of it are using it, you have endless bots racing with each other, and then you have obviously a problem of herding where they're piling up into one idea, coming off of the idea, creating short-term volatility and creating a little bit of disruption. So how do you run ahead of it? Is basically you run a bit more proprietary, a bit more advanced tools that are actually understanding the herding behaviors that these other ones can have, and then you have a more advanced and faster data consumption, so you can actually be in front of it. So it's actually turning into an adversarial AI arms race where the bots are going to trick each other to put them into a herding behavior, who then the other AI, the smarter one, is going to take it all. So it's actually going to move into first phase of it, which we are at, the basic stuff, basic signals, basic momentum signals. All these bots are available commonly, and people trade using these. Some results, because these bots actually achieve the basic hurdles of achieving this type of signals. Next stage is AI to AI games. Basically, AI tricking AI into games. They basically trick each other. And there's a lot of activity that the other thinks it's a signal, it pulls out, and you trick it. So that's the next evolution of the AI bots. And then the next evolution is actually starts the advanced technologies, advanced firms will start taking over the space, because they will actually be more dominant over the random commonly available chatbots, and they will be more herded by these bigger institutions. So I think it's for as Abex we are in the cutting edge of the technology. We build our team with really experts from the top hedge funds and lowest latency possible, and with machine learning engineers building the models. And so we have a very good system running, and it's actually important to mention that within the RapidX platform, our algorithms are already available for any of the LTP clients. And you don't even need to onboard, you don't need to do much. The API makes our algorithms available, and you can trade through LTP. Or if you're not a client to LTP, you can directly reach to us, and then we can set you up with our system.
Alrighty, so before this panel ends, I would love to get one thing that you guys are excited most about AI trading, or just AI in general, or happy to provide one prediction that will come in the next 5 to 10 years too.
Okay, so I think in the next not even 5, maybe 2-3 years, that the development is in an accelerating shape, because every little development increases the speed of the next piece of the development. So I think we're going to start seeing billion-dollar companies made out of one person, because you pretty much need everything you need. You can start an idea, build a website, build the chatbot, or build the pieces together. You can pretty much do all of this, and you can set up a shop that's pretty much automated models. Sends the emails, connects, buys stuff from here, ships it over there, done. So I think we're going to start seeing $1 billion companies. One person.
Totally agree. Actually, my vision is that, like just your talk about, because we are seeing a lot of multi-agent frameworks is coming up. It's using machine to talk with a machine, and trying to do the best decisions before the outcome is coming out. So this is, I think, that we'll see the transitions right now. And another thing I would like to see is, I think in nowadays the most talented people will stay ahead of the GI, even in front of the markets. And the most talented people will do the harness, how we can leverage the general AI technologies to be more secure, and to do more of the accuracy in front of in terms of the market. And how we can, for example, to stop, for example, the machine to overthinking, like just you mentioned, overfit, still happen all the time, and stop the hallucination, because this is not accurate. This is not people think about. It's not logic. So this is, I think the most 10 people were trying to do that, to do the tuning, to do the training in the best way. So so for each of one, I think everyone here, you're trying to be more, be curious. You need to stay alert in front of it. Because every week we will see a lot of the new models. They're trying to achieve the SOTA in front of the world. So this is, I think, the fast changing, but everyone is facing a lot of opportunity. It's not just for us, but also for all startups.
For me, I think the things that are going to predict for like 2 or 5 years is AI plus robotic. So I think things that's moving very fast, especially if you look at Tesla, they all have their own robots. So like 2 or 5 years, I can see that one day there's been robotics helping us to serve us, doing all the physical loads, or even having a maid of robot at home. So this is going to be quite soon, I can predict.
I think things happen, or technology advances much slower in kind of short term than you expect, and then advances much faster in much longer term, say 10 years than you expect, right? So with AI, at least in the Web2 VC world, there are definitely tons of hype. Unfortunately, so for example, humanoid robot, I personally do think that's where the valuation is way ahead of where the technology really is, but as a VC, we're making 10 years bet. Eventually, you will definitely all get there. I think you will see a lot of, if you're more thinking from investors' point of view in terms of what to invest, there will be a lot of boom and bust in the next few years around AI, but we will get there eventually. And then I think maybe just with, sorry, what's your question? No, I think that's really. Oh no, sorry. One last thing. I think the landscape of VC will really change in the next 5 years. A lot of our peers, especially who are only investing in the SaaS, vertical SaaS world, a lot of VCs are very confused with how to invest with the rise of AI. I think a lot of the, especially pure software play, you'll see a disruption of the business model and the entire business landscape, just as how Apple released iPhone, and then a lot of these app stores with the big with the kind of 5-10 people teams running developing an app, they can easily profit and make millions or tens of $million revenue. We don't know for how long. I think that's also happening to the enterprise software world. And the landscape of VC and how we invest will change drastically in the next 5 years.
Sounds good, guys.
Thank you.
All right, thank you very much. Tao Tao, great job. I think value for money, much better than even going to see Tay Tay. So thank you very much once again, Tao Tao Hood, to our panel. You guys did a great job to help us close out the conference today. I'll invite you to leave the stage as we get ready to close it out. There you go. Yeah? Ken. Don't worry, you guys have done your duty. It's cocktail time. That's right. All right. He likes that. The CME group is hosting our cocktail at 5:30 p.m. onwards up on the 7th floor at the Fish Bar. Make sure you bring your badge because security will be ferocious because everybody wants to be in this cocktail. Thank you to Gate.io for sponsoring our coffee breaks and the ice cream today. Thank you to Whitebit for sponsoring our VIP lunch. Liquidity will be back in 2026, so please make sure that you're on all the social media platforms to also get the interviews that they have been conducting with our speakers today. Once again, that's on the LinkedIn, the Twitter, the YouTube, at LTP_Prime Broker. I'm Andrew Work. This has been Liquidity, and I'll see you all at the cocktails. Sayonara. Bye-bye. Good night. I hope so.
Yeah. Yes.
My calendar now.
Next April. Good job.
Thanks, man. Thanks.
Great job.
Well, this guy kept it on going. We did rehearsing last night. He's rehearsing. He's like, Andrew, mistake.
It's my job.
Teamwork. Yeah. Let me share this. All good.